Thanks, Mark, for spending the past hour with us. Point a little higher.
given a more positive interpretation by markets, and that pushed stocks higher, positive in the sense of what it meant for the Fed. But that said, futures looking forwards are a little negative, down by 0.1% on S&P futures right now. We keep oil prices in mind. We see a substantial move higher in oil prices. That could up more than 2%, but that just took us back to where we were a week or so ago. We'll keep that in mind as we head towards the start of trade. European futures flat to positive. That oil price move, though, could still have an impact on what we've seen in London of late. So this is what we see on the European equity markets as they just open up this morning. The CAC is fairly flat. So is the FTSE 100, dominated by grey boxes on the equity indexes column here on the GMM screen. The foreign exchange market, we see the dollar is pretty flat. That's after those substantial moves yesterday in the yen. Some of that continues today, but certainly not of the same magnitude. The euro a little weaker, down 0.1%. We got some data confirming the inflation picture out of Germany a little earlier on at the top of the last hour. We see a little more movement on the equity markets now. The CAC 40 and the FTSE 100 both up by around 0.2%. But as I say, catching up with the Wall Street trade yesterday, some of the cracks identified in the labour market, giving investors once again hopes and expectation that perhaps we see those cuts coming through from the Fed in the not too distant future. This is the sovereign bond story then of this morning. You can see it's all moving pretty much in the same direction, and a lot of it at the long end, but not all of it. The US 2-year, the Swiss 5-year in the mix as well. But many of these are 30-year contracts where we're seeing some selling, and we're seeing those yields going a little bit higher this morning. And this is what we've seen in commodities, and the context is important, as Mark was saying at the end of the last hour. So here's the move in Brent crude. It was up by more than 2%, now up by 1.7%, but the direction of travel in the last few weeks, well, in the last 7 weeks, in fact, has been negative. So we've seen 7 weeks. We're heading towards the 7th week of negativity around the oil price. So we keep that in mind as we look at that very green picture for commodities this morning. Let's look at sectors then and how this all breaks down. So modest gains across European equity markets. That's the top line. And in terms of the breakdown of sectors, we see that the basic resource sector is one of the only ones in negative territory this morning. Elsewhere, we see broad positivity, nothing particularly standing out as far as I could see. The energy stocks getting a bit of a boost from that higher oil price, up by 0.4%. That's one of the bigger moves that we see this morning. But basic resources, as I mentioned, moving a little bit lower as stocks make modest gains. Sophia Horta-Acosta joins us from the Markets Today blog. And Sophia, take us into some thinking around macro themes this morning. I know on the blog you've been covering some of these, and we're looking ahead to a really busy week next week where we get lots of central banks meeting and deciding on interest rates. Let's talk about the ECB, because I know we've surveyed economists, and economists in the market not necessarily on the same page about when we see cuts from the ECB.
No, Anna. So markets are pricing in a cut from the ECB as early as March, and economists don't think that will happen. The ECB is likely to be on hold until June. It really shows, though, that, you know, despite all the efforts from policymakers, including Christine Lagarde at the ECB, to push back against market expectations for interest rate cuts, there is just so much hope that these will come sooner rather than later. So the market pricing for the ECB in particular, the ECB would be the first to move 150 basis points of cuts. That's more cuts than the Fed and the BOE. But you know, I think we could get from next week, it's likely that we'll get a hold from the major central banks, and from the ECB side, more pushing back against market expectations for a cut, perhaps saying that it's even too early to start thinking about it, to start talking about it, but we're likely to get that kind of push and pull between markets and economists in the next few months.
Okay, so that's one of the macro stories we're dealing with. Stepping away from the macro themes then, Sophia, and back to the sort of home turf of the UK, which I know that the blog focuses on. Let me talk to you about what we're hearing from the government around bank failure and readiness for bank failure. The events around SVB in the United States earlier on this year had an impact here in Europe as well, and certainly here in the UK. And so what are we now hearing from the City Minister?
So now, so the Treasury is starting a consultation to kind of strengthen the oversight of this. So nothing really went wrong because SVB UK was bought by HSBC. But what was happening was that there was a rush by businesses to withdraw money before this happened, because startups were facing losses on more than their deposits are protected, which is the threshold is £85,000. So we don't know what this will look like. We do know the City Minister is saying that he's looking at ways to make this as solid as possible. And again, it's to update the playbook for what happens when banks do fail.
Okay, and sticking with the UK, Bank of England meeting next week. Hawkish holds, is that the expectation in markets? And hawkish because the Bank of England might need to push back a little against market pricing?
Again, that's the theme for central banks, right? Pushing back against markets. We do have today, actually, the BOE inflation expectations survey from the public, and that could really be useful for the BOE. That's at 9:30 a.m., Anna. It would show essentially what the public where the public expects inflation to be in the next year, in the next 5 years. Those long-term inflation expectations, whether they're ingrained or not, the BOE is looking closely at that. But a hawkish hold, I mean, I think because every time Andrew Bailey pushes back against market expectations, we on the blog, we look at where those if any of that pricing moves, and it doesn't.
Right.
It's the hard
data.
And
it's not just him. We're hearing it from lots of policymakers. Not all, I was going to say all, it's not all, but certainly some on the hawkish side being quite vocal.
Exactly, and it seems that it's not the rhetoric that changes the market's mind, or the pricing at least, it's the hard data. So again, I do think the jobs, even in the US, that will have an impact here in the UK later today, and we do have jobs data in the UK next week as well, before the BOE meeting. That's a little bit more complicated because the BOE changed how it looks so that it wasn't getting enough responses to the survey. It could be a little bit trickier to read. But again, hard data, more important for markets than rhetoric.
Yeah, that's interesting. And some of we keep an eye on the hard data, and more of that next week, of course. And some of the signals around the data have been perhaps a little more positive. I'm thinking things like the housing market, not as bad as maybe some had feared, at least in the near term. And then even the Bank of England's own assessments of how many people will struggle to meet mortgage payments, that's improved of late. But that's the UK story. Let's just jump briefly to one of the global themes of the day, which is non-farm payrolls, of course. We're actually expecting a bigger job creation engine in the US this time around than we got last month, but down on the year before. Unemployment not expected to shift much. I suppose there's a danger that this data underwhelms a little.
Or I think maybe underwhelms or just confuses everyone, because if we do get, for example, a tick of unemployment, some economists are predicting that. But then the other data kind of points people in the other direction. Then how do you read this? The market is so positioned for loosening in the labour market that anything that either muddies the picture, sends people in a different direction, or a data set that has something for everyone, which has been the case in many reports out of the US lately. I think that will be the trickier, kind of the worst case scenario for markets today. But let's see, I think that will be really interesting for the UK as well.
Okay, well, we'll, of course, read across into UK markets on that blog. When we get that non-farm payrolls data a little bit later on. Sophia, thank you very much. Sophia Horta-Acosta from the Markets Today blog. And you can find that blog by going to the Bloomberg UK website. You can type TLIV Go on the terminal. That's also a way to find yourself in the Markets Today blog. Let us get a look at some of the events that we're watching for in markets then. At 9:30 a.m., we're looking out for the Bank of England's Ipsos Inflation Attitude Survey. We were just referencing that. Sophia just referenced that, in fact. So that comes ahead of the Bank of England's rates decision next Thursday. We'll get a sense of what expectations around inflation look like as that inflation rate has been coming down. What has that done to expectations? So at 1:30 UK time, we will then get the US jobs report. That, of course, will be closely watched by the Fed, which also meets next week. That's on Wednesday of next week. And at 3 p.m. is the University of Michigan Sentiment Survey. So back to focusing on the strengths and weaknesses, perhaps, of the US consumer. Coming up on this programme, we'll check in on the movers this morning, including Anglo American, its shares, the mining company, of course, taking a dip on capital expenditure and production guidance. We'll get an update on the moves there. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing Just think about it. I didn't say had never used a phone. They never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
The top names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Markets Today, 11 minutes into a European trading session that sees us making, I was going to say modest gains, that might be overdoing it. Certainly some of these markets, the French market not doing too badly, up by 0.3% on the CAC 40, but elsewhere, flat to positive. US futures look more negative now, down 0.2% on E-minis, 0.3 on NASDAQ futures. Let's check in on the individual stocks, though, on the move. Joe Easton's been digging deep, found some good stories for us. Joe, what have you got?
So we have got a couple of bits of red on the screen at the top here, and it is JP Morgan doing some damage once again. Firstly, they are downgrading Siemens Energy, putting a sell rating on that stock, saying they don't believe a breakup of the company is likely, and that is hurting some investor sentiment. There was hope around that following issues in the wind business, and they also cut Alstom, the maker of trains, another company, potentially in speculation of a breakup, and also some cash issues. So seeing a bit of declines in both of those at the moment. Airbus, we had in stocks to watch, upgraded over at Deutsche Bank, given the strength in the commercial business, making up for some weakness in defence. That one is rising as expected. And a new buy rating from Goldman Sachs is Sainsbury's heading into the Christmas period. All those delicious Sainsbury's panettones, they are very good. And Sainsbury's investors tasting the difference this morning, scraping the barrel a bit with that one. Anglo-American, you mentioned earlier, down at 6%. They are cutting their copper target for next year. Their production targets are coming down. They want to reduce their spending by around $500 million, according to the CEO at an investor day today. Vodafone is slipping slightly. Now there's a report that UK phone companies have potentially been overcharging some mobile phone customers. That's got a negative read. That's according to the Financial Times. We're seeing that one weighed on there. And then Poste Italiane over in Milan, the Italian government potentially offloading a huge stake in that one, around 29% of the company. That broke a few moments ago. So Poste Italiane down around 1% over in Italy. Hensoldt, now this is a defence company over in Germany, had a bit of weakness. I'm not sure if that price is ticking at the moment. It might be in a halt, but that is doing a share placing. They've got some capital worries. Keep an eye on that one. I suspect we're still waiting for that one to open, but do keep an eye. Puma, Lululemon's results were weak yesterday in the US, but that stock did fall yesterday on concern around some of their labour practices in China. Puma denied the story, but that stock pretty steady given the slump yesterday. Adidas coming back up. It also fell with Puma as well, but sportswear in focus today. Now, in terms of the CAC 40 over in France, it's a comeback for Vivendi. They rejoin the index. According to the producer of that index, they come back into the CAC 40 after dropping out just a few months ago. So that one's getting a boost around 3%. And then Worldline is a new buy over at Citi. Now, that one and Adyen, they like both of the payment companies, following a bit of weakness in there. And Worldline is actually dropping out of the CAC 40. So Vivendi coming in, but those Citi comments keeping the stock slightly higher. So lots moving on the screen today, Anna.
Okay, lots moving on the screen. Thanks very much for the update, Joe Easton, from our equities team with all of those movers. A few red headlines just dropping onto the Bloomberg terminal around China. So let me get to those. We know that meetings have been taking place, the Chinese Politburo talking about the economy, and we're getting some updates there. The Politburo saying that the Chinese monetary policy will be flexible and appropriate, also saying that 2024's monetary policy will be targeted and effective. Interesting, these comments on the PBOC and expectations there. Colleagues on the Markets Live blog remarking recently that a lot of the trading we've seen in Chinese stocks has been not based necessarily on the data, but on expectations of whether the PBOC is likely to act or not. So there has been a lot of expectation that we might see something a little more flexible from the PBOC, or a little more dovish perhaps from the PBOC. So interesting that we get that push from the Politburo and their meetings. They're aiming to expand domestic demand next year, aiming to resolve risks in key areas, maintaining the bottom line on systemic risks, perhaps talking there about property markets and debt levels associated with them. Okay, so that's the China story as it develops. We'll keep an eye on that. The monthly US labor report, though, is also very in focus. It'll be released later today, and it's set to show the US unemployment rate edged higher in November. Bloomberg Economics says, in its view, a US recession is likely to begin in October. Joining us now, Stephen Orth, Executive Vice President and Chief Investment Officer at Federated Hermes, visiting us here in London this morning. Stephen, really nice to see you today.
Likewise, Anna.
Let's start. So we've got the non-farm payrolls data coming out later today. Let's zoom into that, shall we? And cracks in the labour market. Do you see, what are the extent of the cracks in the labour market that you see right now? How is that informing your view?
Well, first, as I said last time I was on the show, we're in this rocky landing scenario. We've never been in, the recession's going to start on July 2nd at 10:30. Then it got moved to October 3rd at 11. Now it's February 5th at 9:30. It's an asynchronous recession that's been going on in the global economy starting almost 2 years ago now. So those looking for recession, I would say, look behind you. It's mostly happened in tech, in regional banks, in housing, in the manufacturing sector. We're now coming out of that in what we would think is something like the end of the rocky landing, call it a soft landing, probably a little bit of bouncy. So that's our framework. The jobs number, I think, for the market relative to expectations, there's bad news possibility, good news is bad news. So above 200, that's good news, that's bad news.
Yes.
Under 100, it's probably bad news, it's bad news. And somewhere in the middle, which is where we think it's likely to come, is probably bad news that's good news. It's more the thing is softening up.
Okay.
And the only problem with this, Anna, is, because of the UAW strike, it's hard for people to figure out what's really in this number. And there may be a lot of talk about that post the number.
Okay, so between 100 and 200, there's a lot of room for confusion, it would seem, about what that means. Above 200, then you say, has an impact. And does, your equity, you have an equities background. What does that mean for stocks if we get that kind of print?
Well, I think instantly we'll sell off. But to us, we like the market for next year. We think more or less the Fed is on pause. We do not see them doing a major series of cuts. The market recently is starting to think about that. We just don't think it's happening. We think the Fed's framework is different than it has been for the last 13 years. Most market watchers still think it's the Fed where, they're worried about the Great Depression and all that. Right now, they're worried about not being the 70s Fed. And they are not going to give up on this inflation fight until they're quite certain it's over and beyond them. So we just don't have a lot of cuts next year. So
the Fed has a longer memory than the market, you think?
Yeah, they're very focused on Jay Powell doesn't want to be Arthur Burns. That's his framework right now. He's not going to cut anytime soon. Watch the wage number today. That's the number the Fed is really looking at. If that number is north of 4, that's more evidence for the Fed that they're not done with this inflation fight, on an annualized basis.
Yes, and so we might get pushback around the market's expectations next week when we hear from the Fed. Let me explore a little bit more this rocky landing idea then. So not a soft and not a hard landing, but rocky. And actually you think much of the recession has already happened then? You think it's actually in the rearview mirror. So what does that mean, Stephen, for growth next year?
We got growth at 2%, so modest growth, not terrific. We have nominal growth closer to 5. We think inflation's going to hang in there, be stubborn, around 3, which we think is probably enough for the Fed to stay on pause. Some people say it doesn't light their hair on fire. Their official target's 2, but I think they've started to realize 3 might be a better target than 2. The downside, if you miss 2, is deflation, and maybe we've had too much of that of late. So we think they're kind of on pause for most of the year, maybe cut late in the back half, modest growth, and then what we're really looking at for next year is simply the old-fashioned grind it out with earnings. And, you know, we've got earnings next year up 12%. They were flat this year. They finally inflected in Q3, which we thought was very important after 4 down quarters. People aren't talking about that. You don't have a recession when earnings are inflecting higher.
Yeah.
And, you know, we've got earnings for next year at $2.50, which is above most of the street estimates. But it's only about 12% higher than where they were in 2022.
Okay.
And the economy is 15% higher by the end of next year. So it's pretty easy for earnings, we think, to get to that
So
level.
maybe a disconnect. Why do you think, Stephen, that, well, is it the case that we always see such a range of expectations around the US economy? And I just have a recency bias that it seems unusual. But, you know, you've got you saying that the recession is done and others saying we're still heading for a really hard landing in the US.
Yeah, I think rocky landings are one of the hardest kind of scenarios to sort out because as you're bouncing around, there's news for the bears and the bulls on both sides of it. That's why even in our view, you know, we're at 50% of our max overweight in equities in our multi-asset products. So we're still telling people, hold some cash and bonds on the side here. You know, we could be wrong. This is not a clear picture, but on balance, we would have the market is grinding higher next year. We've got a target of 5,000 for the end of the year, which is, you know, basically at 12, you know, at 9% return off of where we are.
Stephen, thank you very much. Thanks for your time. Stephen Orth, Executive Vice President and CIO at Federated Hermes. Just a quick word on China. I mentioned a couple of the lines coming through, and interesting to see some follow-up red headlines coming through from that Politburo meeting. Fiscal policy to strengthen appropriately, which is interesting, and saying money policy to be flexible, but dropping the line around forcefulness. So we'll get some further insights into that. Enhancing economic vitality seems to be a focus. So a whole host of lines. We'll get some, try to make sense of those for you. Now, coming up on the program, oil bounces but fails to erase the worst weekly losses run since 2018. We'll have more on that next. This is Bloomberg.
Much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Welcome back to Markets Today. Now, oil prices rebounding this morning, but still on course for their longest weekly losing streak since 2018. That's as the bearish mood for crude appears to be hardening and dominating. Traders are doubtful that deeper supply cuts by OPEC Plus will be effective. Let's put all of that together. Bloomberg's Alaric Nightingale joins us here on the programme. Good morning. So why has oil been falling then? Because we've got OPEC Plus really trying hard to convince everybody they're cutting back on production, and yet the price keeps dropping.
So I think it's really a supply issue or is an important side of this. You've got large amounts of crude coming out of the US, and at the same time, there's some skepticism, as you said, about OPEC's ability to do what it said it will do. So yes, they've made these deeper cuts, but those cuts kind of lean on Iraq, which hasn't got the best track record for enforcing its kind of production commitments. Russia's commitments are unusual and very hard to measure. It's a combination of exports, which is different from everybody else. It's exports of crude and refined fuels. Now, that's really hard to track. My team does that, and it's actually, just hard to put them together and to keep a kind of a very clear idea of what's going on. So it's easy to understand why people feel a little bit unsure about what OPEC is doing and how successful it's going to be in implementing what it says it will do. Doesn't mean it won't.
Okay, right. So that's the supply side of things. And on the demand side, those fears around the demand picture seem to dominate. Just briefly.
They do dominate, but I do think it's important to say that, as your previous guest said, 2% growth, that would be pretty good. So there are concerns about demand. Europe, if you look at our diesel consumption is really, really kind of concerning if you're a bull. So there are definitely demand issues, yeah.
Okay, Alaric, thank you very much. Sorry, that's all we have time for, but big moves in oil prices over the last 7 weeks, dropping for 7 weeks, even if we're bouncing 1.9% this morning. Bloomberg's Alaric Nightingale with the latest on the oil markets. Coming up, we will discuss today's crucial US jobs report and what it could tell us about the route ahead for the Fed. That's next. This is Bloomberg.
Venture capital, it's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. Equity traders are on edge ahead of today's U.S. jobs report. The yen strengthens on rising bets of a Bank of Japan policy shift. European finance ministers inch towards a deal on new fiscal rules. EU Economy Minister Paolo Gentiloni says he's confident an agreement can be reached in the coming days. And the Palestinian Authority says it's working with U.S. officials on a plan to run Gaza after the war is over. The Palestinian Prime Minister tells us exclusively that Israel's aim to fully defeat Hamas is unrealistic. Welcome back to the programme. Plenty to talk about in the geopolitics. We've been playing you excerpts from that exclusive interview with the Palestinian Authority. Let's have a quick check on where we are on the markets, though, right now. And we see stocks are moving higher, up by 0.2% on the Stoxx 600. And the DAX, the FTSE, underperforms just a little. So a slight buoyancy on European stocks. But bear in mind, this is catching up with the US trade of yesterday. We saw a positive interpretation being put on some of the labour data yesterday in the US. And so that led us higher. And we see Europe playing a little bit of catch-up this morning. US futures look a little bit weaker, down about 0.2% on Nasdaq futures, 0.1 on E-minis. Let's have a look at the sector breakdown then and see where that takes us. We've seen oil prices up by more than 2%, and sometimes that obviously lifts energy prices, although the energy stocks, although the direction of travel of late has been negative. 7 weeks of negativity around the oil price. I see energy stocks are in positive territory today, up by 0.4%. We also see consumer stocks doing pretty well, up by more than 1%. A few sectors, though, in negative territory, including banks and insurance. Let us think about some of the drivers on the market this morning. And we've just been dealing with, in the last part of the programme, we were just dealing with some breaking news lines coming through from China. So we'll go to some of those because there was quite a lot to handle in a short space of time. And we need to try and make sense of it and what it might mean for Monday's trading session. Sophia Halter-Acosta joins us once again from the Markets Today blog. Spends her time thinking a lot about the UK right now, but has spent a lot of time thinking about China, including being over there in the Asia region. Sophia, help us understand. We got 5 red headlines from the Chinese Politburo, a lot of words around monetary policy and fiscal policy. What stood out to you?
So they dropped the forceful word and introduced the flexible word when it comes to monetary policy. Now, what does that mean? Reading monetary policy in China is all about signaling. So this suggests, I mean, the market will read this as China is ready to essentially do more when it comes to stimulus, perhaps. Also look at fiscal policy. I mean, that's really what China has been holding back so far because of those debt risks. One thing that also stood out to me is that China vowed to control systemic risk, but there was no mention of the property market. I think people will be kind of confused.
That's the assumption you make, though, looking at that. You know, you talk about systemic risks in China and you think property.
But there's no clarity there over which systemic risks specifically. Are there any new ones? For example, is Beijing looking at the local government debt market? Are there risks to the financial system, perhaps new ones that weren't mentioned before? But again, I think the market still needs to digest this because it's not, it's very typical China, is that it's not specific. And we're looking at which words have been added, which words have been removed. And the fact that it was forceful that was removed and flexible added, I think that's quite a clever strategy from Beijing because, I mean, flexible can be 2 ways, right? Because it also doesn't depend on what's happening in China. The global situation as well, especially if you have the Fed cutting, the ECB cutting, the BOE cutting next year, that will also impact Chinese monetary policy. But very, very interesting, Anna.
Yes, some of our colleagues suggesting this is the Chinese Politburo seeking to jawbone confidence into investors. But yes, it maybe comes down to a bit more deeper analysis on the dropping of forceful, the adoption of flexible, and what all of that means as a signal. Sophia, thanks very much. Thanks for joining us. Sophia Horta-Acosta from the Markets Today blog. Now, let's pivot back to the US themes this morning. We're set to get November's US jobs report later today with expectations of a pickup in hiring. Ahead of that, continuing jobless claims fell by the most since July. Gina Martin-Adams joins us from the Bloomberg Intelligence team, usually in New York, but I'm very pleased to say making a trip to this side of the pond. So, Gina, really nice to see you. Thanks for being with us on set. So let's start with your NFP expectations. We expect, actually, more jobs to be created in this set of data than the last set. Unemployment expected to stay steady. At least these are the market consensus expectations. What are you going to be watching for?
Yeah, I think it's really such an interesting situation because every other indicator that we follow would suggest the U.S. economy is flirting with recession, except for employment conditions, which have remained quite stable over the last couple of years. Economists are generally forecasting another stable employment report. The unemployment rate has been ticking higher, and I would watch that in particular because if the unemployment rate keeps ticking higher, it does suggest that at least there is some labor market loosening, and that may unlock the handcuffs that are on the Fed right now. The Fed is certainly enjoying the deceleration in inflation. This idea of disinflation has certainly taken hold, but without the job market weakness, I think there's certainly questions as to how profound the disinflation is. Are we at a point where monetary policy is too tight or not?
Yeah.
We need to see the unemployment rate continue to rise if we're going to get those Fed cuts that have been miraculously very rapidly priced into the equity markets as well as the bond markets over the last month.
Yes, and in any cycle and in any slowdown, we often do have to wait a little bit longer to see the labour market react, don't we? So that's where we are right now. But in terms of the outlook for 2024, there seem to be so many different trajectories in the conversations around the US outlook. People talk about a soft landing. Others talk about, no, we're heading for a hard landing. Look how much rates have gone up in a hurry. And my last guest, also visiting from the US, was talking about a rocky landing, and that's just very difficult to interpret, and he actually sees the worst behind us. So what are you expecting to see in 2024?
Yeah, I think that there is this really great uncertainty with respect to where we are in the economic cycle. Our models would tell us that we've already had a landing. We had a major deceleration in economic activity in 2022. We've been flirting with recession since 2022, and we're back in a period of weakness headed into 2024. That sets the equity market up quite differently than I think many people are accustomed to believing, because when you've had nearly 2 years of weakness already absorbed in equities, equities are priced for a perpetuation or a continuation of the weakness to come into 2024, with the exception of very few names. You've got tremendous discounts across equity markets, even in the U.S., especially in small caps. So this result is, as long as the economy doesn't weaken materially, stocks are already well prepared for weakness to continue. What they're not prepared for is any sort of recovery to emerge. But it's absolutely not priced in the equity market, even though the sell-side consensus expectation is saying that we're going to get some kind of growth out of earnings. Our models would suggest that the market is priced for a roughly 0% earnings growth over the course of 2024.
Right, which is a really interesting disconnect, isn't it? And you mentioned small caps. You know, the Magnificent Seven story is not the same as the small cap story.
Even close.
And we've actually had small caps performing quite well of late. So what's going on there with the small cap universe?
Well, look, let's keep in mind small caps made a new low in October, so they've performed quite well, but they're still in the midst of one of the worst bear markets in U.S. small cap history. It's the second worst, in fact, in terms of duration, and the drawdown is very consistent with an economic recessionary experience. So what we've seen in small caps is really clearly reflecting what we see in our broader economic work, which is a pretty significant downdraft in broader growth, as well as an updraft in inflation pressures, has resulted in tremendous distress in the small cap index and, frankly, in the 493 S&P 500 as well. So within small caps, I do think if you get any kind of economic momentum boost, if you get any kind of earnings recovery emerging in 2024, that could be a huge boost to small caps, which have been in distress. They probably do, though, need some sign of Fed easing. If I were to say one thing that has really overwhelmingly impacted small cap sentiment, it is the debt market and the idea that these companies' cost of capital is going to move materially higher, reflecting higher Fed funds rates, higher long-term interest rates as well. Their access to capital has become somewhat more constrained than in the past, and they certainly have to pay a lot more for it. So financing costs are a huge issue for small caps to contend with if we get any easing there next year.
Okay, and you mentioned 493, and for a moment that tested me, but then I caught up with you. Okay, 500 minus 7, I think I can get there. What about cyclicals and defensives? What's the story that you're looking looking at when it comes to the different sectors and parts of the economy?
Yeah, I think, well, first of all, I would say that from a sector perspective, what is cyclical versus what is defensive is now up for debate. In an environment where interest rates are higher and are having a significant impact, where inflation is now part of the conundrum facing U.S. companies, the traditional defensive sectors have proven pretty inept at containing or contending with these pressures. So you've got companies such as utilities and consumer staples, as well as healthcare, which have vastly underperformed over the course of the last year or so. They did quite well in 2022, but then we found out that their earnings were going to come under distress in 2023. So I do think that what is defensive and what is cyclical is up for debate. When we look at our sector strategy, it does right now point to what are more traditionally cyclical industries and sectors as best positioned to contend with the current climate. So it sits in financials and energy, as well as tech and communications on the large cap side. I'd say the biggest thing that stands out for us is financials, with the yield curve starting to upwardly steepen. Financials looks like an area where investors should be taking a peek, even though sentiment is quite terrible in that space right now.
Gina, thank you so much for joining us. Gina Martin-Adams from Bloomberg Intelligence, visiting from the United States with really interesting insights on where we are on the U.S. story, the U.S. Equity story in particular this morning. Here are some of the other stories that are being read well on the Bloomberg terminal this morning. Citigroup has promoted over 300 employees to managing director after the bank's rates and currencies traders posted their best third quarter in a decade. The biggest share of promotions went to the markets division. Citi is currently undergoing a restructuring drive as part of CEO Jane Fraser's efforts to simplify the Wall Street giant. Bloomberg has learned the project lead on Tesla's Dojo supercomputer has left the company. The Dojo system is a supercomputer made to handle data and to train autonomous driving systems. Former Apple executive Peter Bannon will now head up the project, which Morgan Stanley has estimated could add $500 billion to Tesla's value. Sales of semiconductors at TSMC have slid back into contraction following October gains, indicating the global chip market still has a way to go before a full recovery from its prolonged slump. The world's largest supplier of made-to-order chips recorded a $6.6 billion drop in revenue in November. Mackenzie Scott has donated more than $2 billion to charity over the past year, according to an announcement on her website. Yield Giving, she has now given to 360 organizations since last December, including numerous legal aid clinics and community health non-profits since her 2019 divorce from Amazon founder Jeff Bezos. Scott has given away more than $16.5 billion. Coming up on the program, could artificial intelligence play a big role in helping to meet the world's COP28 climate goals? We will have that story for you next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City, from London, in Sydney, from Washington, in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Welcome back. This is Markets Today. We are 44 minutes into our European trading day, and European equity markets actually bouncing a little more now, up by 0.3%. The FTSE up by around 0.2. Some of the better gains coming through from the French market were up by 0.7% on the CAC 40. Now let's talk about what's going on with a number of themes that have been really topical, AI and climate this week. European Union leaders will reconvene today to try to hash out an agreement on artificial intelligence regulation. If agreed, the deal will be the most comprehensive of its kind in the Western world. The talks come as COP28 is underway in Dubai, where business leaders have been discussing AI's role in achieving climate goals. Let's speak now to Rebecca Minghella, who's the founder and CEO of Clarity, an AI-powered sustainability platform. Rebecca, thank you so much for joining us from Dubai, of course, attending the COP28 events, and we look forward to your thoughts on that front. If I could just ask you about the legislative backdrop in Europe for a moment, because we know that those conversations are ongoing at the European Union, and I know that we don't know the detail of what it will look like. But what are you hoping or fearing the EU will put into this new AI legislation?
Good morning, Anna. Thank you very much for inviting me today. So in terms of the European legislation of AI, it's still early days to understand the potential impact that it might have for the industry. Of course, there needs to be some regulation or some kind of regulation on AI at different levels. The European AI Act is focused on defining the different governance and risk, different levels of risk on AI, and that's very needed. Now, of course, the concern is if that's going to have an impact, given it's at the European level only now. There is a concern about how is that going to impact the competitiveness of the business in Europe as well, right?
Yes. Does it risk pushing forward that view? Is perhaps too much of a summary, if you like. But is there a risk that it just adds to the perspective or the view that the US innovates and Europe regulates? Is there a risk of that here?
Yeah, so basically we see the risk. I mean, with regards to how we use AI at Clarity, we will be categorized in the low to limited risk levels, so that will not really have a big impact for us. We will just need to of course, be transparent with our technologies, have a proper governance and policies, etc. But of course, when you start entering into the high-risk areas, certain types of application of AI for certain industries, there is a lot of controversy on how is that going to impact, again, the competitiveness of businesses, how the governments are going to be using those technologies, and of course the practicality of applying many of the indications of the regulation. But again, it's still very early days, so still quite undefined in most of the most critical areas, I would say.
Yes, and let's move the conversation forward, Rebecca, because AI is still being a topic of conversation at the COP28 meetings that are taking place in Dubai, where you are right now. Your business is focused on using AI then to achieve some of the climate goals. How convinced are you that we're dealing with really reliable data in this space on broader ESG, but specifically around the environment?
Yeah, so one of course of the challenges to move faster on climate transition is the availability of data and tools to understand the impact or prioritize resources. The AI and the application of technologies, not even that as sophisticated as AI technologies, but just access to specific data, access to tools to better understand investments even without AI, is super important. AI is now being applied to estimate data that's not available for emissions. More importantly, in developing countries where the lack of availability of data is even worse. And the scalability of AI allows to measure climate transition at a scale, and that's something that is helping accelerate the achievement of the commitment that are being done. But we are still, I believe, we have still a lot to do on adoption of those technologies, because those technologies are available, but are not being adopted at the speed that they should.
Yes, a lot to do on that front and a lot to do on the Paris goals, Rebecca. What is your overall thinking around COP28 and the goals that have been met around Paris and have not? Because I know that this is a year where a global stocktake is underway. We spoke to Bloomberg New Energy Finance before COP28, and they told us to have pretty low expectations about the stocktake.
Yeah, I mean, there is a lot of expectations every year around the COP, and there are a lot of very important commitments being done every year. But the question is, are we really delivering on those commitments? And that's my concern. I'm an optimist, and I want to believe that we are going to keep acting faster and progressing towards meeting the goals of the Paris Agreement. But the reality is that we are very far yet. And again, if you look at the numbers, at the end of the day, we are a company that is numbers-driven. Investors or the financial industry still complain about the availability of data or technologies. The technologies are available, right? At least they are good enough for implementing many of the actions. And still, 40 to 50% of them, they complain that the technology or the data are expensive when they are only investing, as of today, in the ESG sustainability analytics, around $1 billion, when they spend $50 billion in financial risk data or $220 billion in cybersecurity, right? So still the investment in sustainability or climate data is far what it should be, right?
Rebecca, thank you very much. Rebecca Minghella, the founder and CEO of Clarity AI. We thank her for joining us. Another red headline across the Bloomberg terminal. We're busy this morning. Let us just get to that then. The EU is considering restarting its WTO case, its trade case, essentially World Trade Organization case, against the US over steel tariffs. So the EU is considering opening this case against the US over Trump-era steel and aluminum tariffs. This dispute that saw the allies hit each other with tariffs on more than $10 billion worth of goods. But importantly, the EU will refrain from immediately reimposing retaliatory tariffs on American goods. This is according to people familiar with the discussions. We're watching this very closely as we run up to US elections. There's been a lot of talk about how the Europeans were going to play this as we run up towards the elections and how much they wanted to agitate on this front or not, with thinking about a US political battle that might feature former President Trump, of course. So that is the latest on that EU story. Negotiations will continue on these tariffs. Now, coming up on the program, from the House of Hermes to Gulf Royals, we will bring you Bloomberg's annual ranking of family fortunes next. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup.
This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley.
This is Bloomberg. Welcome back to the programme. 8:54 here in London. Now move over Waltons. Another family has emerged as the richest dynasty in the world. For the first time, the House of Nahyen has joined Bloomberg's annual ranking of family fortunes with a $305 billion fortune. The Nahyens of Abu Dhabi have topped the Waltons of Walmart. Another new entrant, the Al Thanis, the royal family of Qatar, of course, are at number 5. And in third place, the family that's run the luxury brand Hermes for 6 generations. They are currently the richest in Europe. A lot to digest there, but let's focus in on the European part of this story, the Hermes story. Bloomberg's Tara Patel joins us for more from Paris. Tara, great reporting here. What is behind the success of Hermes?
Absolutely. Hermes is sitting at the top, the crown jewel of this huge industry. So we really kind of dug down to look and see what the ingredients are of their secret sauce, and we came up with 3. The first being that the Hermes brand really focuses on artisanship, production, hand-making bags in little ateliers across France. And this makes their products exclusive, the second ingredient, so that customers who are willing to fork over thousands of dollars for bags feel like they're getting something special. And the last ingredient, making it scarce, that they're willing to wait for months, sometimes years, for models of bags before they get a certain color or model that may have been sold out.
Yeah, absolutely. So building that waiting list, really important to the strategy. Tara, thank you very much for that. Tara Patel joining us on the Big Take story. I'm sorry we didn't have longer to talk about it, but all of that really good reporting around global wealth and where it sits with these very wealthy families available on the Big Take function on the Bloomberg terminal. That is it for markets today. You can get insights from us and the rest of the team on the Bloomberg UK website. That's where you'll find the Markets Today blog, or you can find it by going to TLIV Go on the terminal. Have a good weekend, everybody. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He caught himself
self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. A nervous wait for the latest U.S. jobs data and potential signs of further cooling in the labor market. We'll discuss what it means for monetary easing and whether bets on Fed cuts have gone too far. EU finance ministers are scrambling to find an agreement on new fiscal rules for the bloc. The economy commissioner, Paolo Gentiloni, says an agreement can be reached in coming days. Plus, more of our exclusive interview with the Prime Minister of Palestine, the Palestinian Prime Minister, who says a Palestinian Authority is working with U.S. officials on a plan to run Gaza after the war is over. Now let's take a look at the European markets map. So as we look, of course, into the weekend, a lot of focus not only on treasuries, but a lot of focus on what we saw yen do on the back of BOJ speculation. Now, stocks are steady. I guess some are saying it's not a technical term, but they could be a little bit nervy, waiting for that U.S. jobs data. Again, I think a lot of market traders are waiting or not for some evidence on whether the labor market is cooling fast enough then for the Fed to be closer to reducing interest rates. That's really what the markets want to know. So for more on the markets, I'm delighted to be joined by Christian Keller, Head of Economics Research at Barclays, but also with us here in the studio, Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence. So Christian, great to see you. So good to have you as well here in the studio. Gina, talk to me a little bit about, if you look at equities, if you look at what's pricing, it's still a lot of, will they cut? Yeah. When they cut and how much will they cut? Do you believe that the Fed is there yet next year?
It's such a tough question right now, and I think this is what, like you suggested, the market is a bit angsty about tomorrow because it is the one cog that seems to be holding up so well is the employment situation. When we look at the leading economic indicators index, it's just completely crashed. It's down more than 7% year over year. It's never been that low in a non-recessionary environment. It started crashing in late 2022, and yet employment still seems to be hanging on. So it's been this very long wait for employment to start to capitulate to weaker economic data, and yet it's not. And so this is the conundrum where we now have that wonderful disinflation. We are starting to see earnings stabilize a little bit, reflecting that disinflationary landscape that emerged in 2023. But will we get the Fed cuts, or will we have to contend with higher for longer interest rates in 2024 is still a huge question mark in the equity markets. And certainly everyone is very confused. No one believes that the earnings stream can recover, so we're much more dependent upon the Fed to sort of ease our concerns to get that upward momentum emerging in the equity market again.
Yeah, so Christian, how do you expect it to play out? And again, as Gina says, it's just very difficult to read because there's also belief in the markets every 6 months that something will collapse, and then everything's repriced as, we have economic data that actually shows stabilization.
I think there's a bit of a disconnect between most of the economists, academics even I've read recently, who think that generally a lot of the disinflation that we've seen, and it was great disinflation so far, a lot of this has come from goods, and that was a supply side effect. Supply side improved, all the supply side chains in a way. That trouble is over. What we need for the so-called last mile now is, however, a little bit help from demand. Core services, the super core measure that the Fed talks about, is still quite strong. And we are more on the conservative side. We think that could get a bit more sticky. Admittedly, the recent data was good. We see what the labor market data brings today. We actually think the labor market is still quite robust. And so, if we get told today that actually it's much weaker than we thought, we may have to adjust a bit. But we think the market went way ahead with regard to the rates cuts, its pricing. And I also think what's interesting is the equity market seems to be hoping for lower rates to support the equity valuations. But some of the fixed income investors, they seem to be buying bonds because they believe there's going to be a recession. So you cannot have both, because if you have a recession, the equity market doesn't seem to be pricing in an earnings recession, while the bond market is somehow, just pricing the lower rates. And even if it's a recession, I think that's okay with us. That's good for bonds. And I think we have again a situation whereby the two markets seem to be looking at different scenarios, or they're looking at a very narrow scenario where everything falls together, Goldilocks, where we have continued growth, but inflation just comes down to 2 without anything.
But Christian, first of all, we spoke to Bill Dudley. Here is what he said on Fed 2024.
I think they're going to be a little slower to cut rates than what the market expects. And I think the reason for that is they want to be highly confident. Those are Powell's own words, that they're going to actually get inflation back down to 2%. So to be highly confident, they need more than a couple months' data showing progress on the labor market getting a little looser, wages coming down, and especially service sector inflation becoming less intense. So I think they'll cut rates in 2024, but not as much as the 100 basis points of rate cuts that are currently penciled in.
Christian, I said like Fed 2024, like if it was running for office, it's not. But talk to me about your base case for inflation. You believe that inflation, U.S. inflation, could actually be a little bit more stubborn than the market's pricing in?
Yeah, but when we look at, the PCE core inflation, without getting too technical, but that is, of course, a term in a way the Fed supposedly looks at, and we see that closer to 3, I think 2.8 or so, a point estimate for the end of the year. But we're seeing that with the Fed staying on hold until the final month of the year, December, that is. And we see, a U.S. economy that during the course of the year, slows significantly, doesn't fall into recession, but also comes down significantly from the pace that it is at now still. And, that scenario is certainly not what market is pricing. And again, people like Dudley, central bankers, they talk similarly, that you want to be confident. But markets seem to be more, in a way, optimistic on the rate cuts. I think politics may play a role. Some people believe if the Fed doesn't cut until June, July, then they may have to wait until December, but they probably want to do it earlier to avoid the risk of a recession. So markets believe the Fed is much more cautious on not wanting a recession, while most observers like us believe they're more cautious on getting inflation really down to 2%.
And Gina, I love your research. So you have this data-driven research, and I think you put most important charts of the week. And I know this week you spent quite a lot of time looking at liquidity. So when you look at some of the indicators that give us a sense of where earnings per share go, what are you looking at outside of kind of what everyone else is looking at?
Yeah, I think this is a great question because there's so many different things that are running around the market, and all of them are with respect to the Fed. And the latest sort of rumors, if you will, that have been floating around in the market is that the equity market is only trading on liquidity. And what's happening with the balance sheet and with Fed changes in liquidity is what really matters for the equity market. And while I do think liquidity is a portion of the story, I think earnings are really important to follow. And frankly, I disagree with the notion that the equity market is not priced for recession. I think the equity market is absolutely priced for recession. There are 7 stocks in the equity market that are not priced for recession because they've experienced a miraculous earnings recovery related to AI and capital spending. But when you look at things like small caps, for instance, small caps have been in one of the worst bear markets in U.S. history, second worst in 40 years. And small caps are trading at enormous discounts. So the small cap index would tell you that the equity market is very prepared for recession and also priced for it to continue. When we run our models, we use things like macro indicators like the unemployment rate, durable goods orders, commodity prices, as well as interest rates.
And that tells us that the equity market is anticipating 0% growth in earnings over the next 12 months. And I think that the sort of popular ways to look at the equity market are simply look at the broad valuation ratio, look at what the consensus is expecting for earnings. But that's not always what's really priced. I think we need to dissect the index pretty carefully. And frankly, I do think that there's a lot of potential upside if the economy comes in a little bit better than anticipated, if companies can manage to produce earnings growth. As has been the case throughout 2023, companies have been beating expectations, which were very, very low. I don't think there is any expectation of a miraculous earnings recovery embedded in equity prices. So as we go back and forth on what's the Fed going to do, how's liquidity shifting, how is that going to impact valuations, it's still important to keep your eye on that earnings stream because it could surprise us in 24.
And I want to ask you also about private markets and actually some of the analysis that you've done around that. But we also have the German finance minister, Minister Lindner, talking about the fiscal rules. Now, Germany really at the forefront. He's being doorstep and he's arriving at the council meeting. We're just waiting for him to maybe give us more of a sense of how the constitutional court in German ruling changes the way that they can spend going forward and whether it's really holding them back. So I know also Christian Keller is 100% on top of that. German France, he says, is at a 92% agreement on fiscal rules. I mean, 92%, we're nearly there. So it's not a done deal, but we're nearly there. Minister Lindner also saying that he's still concerned about corrective elements of rules. So let's, first of all, Christian, let me come to you on how you're expecting some of the fiscal pacts that were really forgotten during COVID era to come back. How limited also is, because of that court ruling, Germany on how they spend money going forward, and how much of a headache is that?
You said I'm 100% on top of this. I think no one is 100% on top of this. Frankly, I don't think the German government...
You're 110% on top of it.
I don't think the German government does know exactly what they want to do at the moment. But, you know, the headline number, 60 billion, is, of course, one over several years. And so what it comes down to is 23, 24. 23 they seem to have solved now by declaring another year of emergency. And then it leaves 24. And there, it seems to be a number somewhere between 15 and 20 billion. You know, 17 billion, I think, is a number that the finance minister himself mentioned. Now, that is in principle doable. So we actually think the macro implications for 24 are limited. And a lot of people were concerned whether this is now what really drives Germany into a proper recession. You know, the question is how they overcome these 17 billion. You know, will they start cutting some of the additional social spending they were planning? You know, there was a lot of additional spending they were planning for the budget for 24. Or, you know, will they cut some of that? And, you know, another question is how they will solve the longer term issue. And, you know, for that, they would need a 2/3 majority either way. Either they trying to change the debt brake, or they try to establish another fund the way they did with the defense fund, but even, you know, for climate. But even for that, they need a 2/3 majority. So it will be politically very difficult. And I think Germany has now to take a few difficult decisions. That's why I think the outcome is still very unclear. But 2024, we don't think it will be a massive macro impact.
Thank you so much, Christian. And Gina, just to finish us off in terms of maybe some of the sectors that you like. I mean, I could speak to you for like a million years on just some of the great charts that you had this week. You look at like proprietary indexes to really show us or try and figure out where we go next.
Yeah.
But do you have a breakdown of what could outperform the rest?
Yeah, so from a sector perspective, our U.S. sector scorecard, both large cap and small cap sector scorecards, have recently highlighted financials, which, you know, really is unexpected and certainly creates a lot of uncertainty. Investors can't stand this space. They're very scared of the banks. So we spent a lot of time really talking about financials and what could spark recovery there after 2 years of really poor performance in that group. And it really is about the yield curve and how prepared banks are for a potential crisis emerging. We looked at things like loan loss reserves, which large cap banks have actually built up about half of the loan loss reserves that they had for the COVID crisis. So they're relatively prepared for a pretty significant economic meltdown. About half as bad as COVID would be still a very severe economic recession experience. So that's something to certainly watch, as well as the yield curve recovery. And then I'd go to regional strategy as well, because we did update our global scorecard. Unfortunately, it's not great news for Europe, which still sits toward the bottom of our global scorecard in developed markets. But it is still pointing to emerging markets as an opportunity for 2024. And I think that surprises some risk-intolerant investors out there.
Christian's outraged at that. Gina, thank you so much. Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence. Christian Keller from Barclays stays with us. We'll talk a little bit more about the dynamics between China and the EU. Coming up, can European finance ministers strike a deal before the end of the year? We'll return to Brussels next, and this is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world. Welcome back. European Union finance ministers are making progress on an agreement on new fiscal rules for the bloc. Now, officials held talks well into the early hours in Brussels. Now, the French economy minister, Bruno Le Maire, says he is pushing for a deal before the end of the year.
We made progress, and I really think that on the 5 remaining percent, we can find an agreement by the end of this year. It requires a lot of work. We stand ready to work very hard to get an agreement by the end of 2023.
We're almost there. Last night it was not possible to finalize all the pending consultations of a technical, a political, also a legal nature. But we hope to be finalizing this in the coming days. And if necessary, we would convene an extraordinary ECOFIN.
Well, just minutes ago, also, that breaking news, EU finance ministers have picked Nadia Calvino, who you were just seeing in that clip for the top EIB job. So we'll see exactly where that brings us. She had spoken in the past about some of the things that she'd like to focus on and push on. Now, for more on all of this, let's bring in Maria Tadeo, Bloomberg's Europe correspondent in Brussels. So, Maria, where are we now?
Yes, Francine, good morning and good to see you. On Nadia Calvino, just very quickly. This was a job that we know the Spanish government wanted. They lobbied really hard to get her this job. It would mean now that she would exit the Spanish government. And of course, that means that she will no longer be the finance minister of the country. So that is the significance of it. And it also means that Margaret Vestager, remember, she was the star commissioner for many, many years, has lost that job. And there's now very serious questions about the political future of Margaret Vestager. Many would say her political star has now faded. Now, in terms of the meeting today in question. As you say, Francine, there was a Eurogroup meeting. It ended at 3 a.m. in the morning. So we're back to this fiscal debate, and it really underlines that fiscal rules, but also economic governance is back at the forefront of European policy making. Now, as you say, Francine, there is no deal yet, but this morning there is an optimistic tone that there will be a reform of the debt and deficit benchmarks. Remember, this is a 60% debt to GDP and the 3% of European economic governance. What we are being told is that there is a new proposal that has been agreed by the Germans, the Italians, the Spanish, and the French, and that we're now almost 95% there. Remember, this matters because the European Central Bank has said they want to get this reform done before the end of the year. They want to send a clear signal to markets that they are serious about fiscal discipline, but also there was a serious question too about the growth prospects and the investment. So we are told no deal for the time being, but one is expected to happen before the end of the year.
Thank you so much. Maria Tadeo there in Brussels, of course, following the proceedings. Now let's bring back Christian Keller, Managing Director of Economics Research at Barclays. Christian, where does Europe sit right now? I mean, I was making fun of you that you disagreed with Gina, what she was saying, which I know is not true. Europe has many challenges ahead.
Yeah, I mean, first of all, very quickly on the fiscal rules, I think as messy as it is, it's actually showing now that it's a good thing that Europe has some kind of a fiscal anchor. If you see what's going on the other side of the Atlantic in the US, where markets are getting a bit concerned that, the US is running huge deficits, which, no one really seems to have a plan to bring them back. But back to Europe. Europe has been stagnating for 2 years almost, and we don't see much change. Recent data suggests that Germany actually is probably in recession now, with the fourth quarter likely to be negative growth. At the same time, with inflation coming down, wages having grown quite rapidly, so you should have a real income increase next year, which we think will avoid a really deep recession. So what we actually expect is slow growth next year, but on a sequential basis, probably improving during the year. So, not a very exciting outlook, but probably with also limited tail risks.
Christian, thank you. Christian Keller there, from Managing Director and Head of Economics Research at Barclays. Coming up, the yen struggling for direction as focus shifts to today's crucial U.S. jobs report. We'll discuss what this means for both the Fed and the BOJ next. And this is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So the yen struggling for direction after yesterday's surge. That's as the focus shifts from speculation of a near-term policy move by the Bank of Japan to U.S. jobs data a little bit later today. Now joining us now, Bloomberg MLive strategist Ven Ram. Ven, great to speak to you. I love the fact that now, because of the wild swings, we have a lot of people telling us the yen is just too tricky to trade. Where do you see it going?
Morning, Francie. I think that the yen is definite upside in the short term because there's lots of speculation that the BOJ will do something next. The meeting is live. I don't think that the BOJ is prepared to move just yet. The noise that we have heard from the BOJ this week is all about the preparatory groundwork needed for them to do something eventually. When is that eventually going to come is probably in spring, if you ask me, because that's when the labor negotiations will take place. So, and they need confirmation that there are wage pressures that are sustainable. So, and therefore, I think that this, in the short term, in the run-up to the meeting next week, I think that the yen has definite upside. But as soon as the markets realize that nothing is going to come after next week's meeting, I think there will be short-term profit taking. But in the run-up to the spring, I think that the yen has definite buoyancy.
Ven, thank you. I know we'll get back to Ven, of course, with more analysis. Option traders also saying that investors were left a little bit, confused and unsure following this roller coaster ride. Some saying that the markets may be headed into a dollar bear trap this evening if the U.S. payrolls data surprise on the strong side. As always, our Ven Ram there with the latest. Now, coming up, the Palestinian Authority says it is working with U.S. officials on a plan to run Gaza after the ongoing war is over. The Prime Minister adds that Israel's aim to fully defeat Hamas is unrealistic. Our exclusive interview, Mohammed Shtaye, that's coming up shortly, and this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will the
this be the last of its kind? No, this is the nature of capitalism. Get over it.
The top names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
A nervous wait for the latest U.S. jobs data and potential signs of further cooling in the labor market. We discuss what it means for monetary easing and whether bets on Fed cuts have actually gone too far. The Spanish finance minister, Nadia Calvino, is picked for the top job at the European Investment Bank as EU finance ministers scramble to find an agreement on new fiscal rules for the bloc. Plus, more of an interview with the Palestinian prime minister, who says the Palestinian Authority is working with U.S. officials on a plan to run Gaza after the war is over. So good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, in an exclusive interview, the Palestinian Prime Minister has told us the Palestinian Authority is working with U.S. officials on a plan to run Gaza after the war with major international help. Mohammed Shateh also says Israel's goal of eliminating Hamas is unrealistic, and he hopes the militant group will instead join as a junior partner in a new governing structure. Well, he spoke to Bloomberg's Ethan Broner.
We tried 4 times or more to come to an agreement with Hamas.
And it didn't work.
And correct. And we signed 4 agreements. Unfortunately, none of them was ever implemented.
By them?
By them. And recently we have had a dialogue in Egypt and Al Alamein, and we agreed on certain issues. We did disagree on a number of issues, and we did form a committee to keep them engaged. That was the idea. But unfortunately, all these sort of things has happened, and then now things are going in a totally different direction. Now, for Israel to say that they are going to eradicate or eliminate Hamas, I don't think that's a possible goal to achieve, simply because Hamas is not in Gaza only. Hamas is in Lebanon, Hamas in leadership, everybody knows, in Qatar, and they are here in the West Bank, and so on and so forth. So what is needed really is a situation in which that Palestinian unity should be allowed to function on very clear points and agenda. We did put together certain points for Hamas to accept. They never accepted, including recognition of international legitimacy, United Nations resolutions, PLO commitments, and so on and so forth. We even invited Hamas to become part of the Palestine Liberation Organization. They never wanted to. Hamas wanted to take things their own way, either their way or the highway, and it seems that we are on the highway. So that is where the situation is. Now, as I said, whether Israel will be able to achieve what they are claiming to do, I doubt that.
But on the other hand, and in no way to say that you are in favor of what's happening, the suppression of Hamas ultimately needs to happen in some way. If they're not going to come into the PLO, if they're not going to forswear their armed struggle and join in some international legitimacy, what needs to happen with Hamas? What can you see happening?
Well, I think Hamas before October 7 is one thing, and Hamas after is another.
That's a very good point. And so?
And therefore, I think if they are ready to come to ground, to an agreement, and really accept the political platform of the PLO, accept the tools of struggle, because this is an important point of difference between us and them. And then there will be a room for talk. Otherwise, it's just simply things will continue to be the same. And even Palestinians should not be divided. We have been divided, unfortunately. Hamas took over Gaza by force in 2007, and this should not have lasted for 17 years. But obviously they were enjoying it there, and they were enjoying some sort of political safety net, funding, other issues that has kept them for 17 years, including the strategy of the Prime Minister of the State of Israel, because we knew and we know that Netanyahu's strategy was to keep Gaza totally away from the rest of the Palestinian territory in an attempt to kill every possibility of a Palestinian state. Netanyahu wanted to keep Gaza away, and he gradually or incrementally started to annex certain parts of the West Bank. Jerusalem has been put under a wall, surrounded with a wall. The city of Hebron is divided between H1 and H2. The rest of the West Bank is fragmented between area A, area B. All this design has been there to achieve one single goal that the Prime Minister of Israel wanted, which is to kill every possibility of a two-state solution. I think, my dear friend, your audience should know that the Palestinian people are under military occupation. The American public maybe and the international public don't know that. We have been under direct military occupation since 1967. And Palestinians have been engaged with Israel peacefully through negotiation to try to end this. And Israel never wanted that. On the contrary, Israel was manifesting its occupation through colonization program, building more settlements. Today you have 755,000 Jewish settlers who are living here illegally. Thanks, the United States recently decided to cancel any waiver for visa of settlers who are here. I think this measure should apply to all settlers, not only those who are engaged in terrorist acts against the Palestinians.
Mohammed Shtayyeh there, the Palestinian Prime Minister, speaking exclusively to our Ethan Broner. Now, let's discuss the ongoing geopolitical tensions with Tina Fordham, founder and geopolitical strategist at Fordham Global Insights. Tina, as always, thank you so much for coming on. I mean, we're going beyond tensions. I mean, these are two wars ongoing. End in sight for either of them.
I think your interview with the Palestinian Prime Minister was quite enlightening about the position of the government and the difficulty of incorporating Hamas on the one hand into a political solution, as well as the weakness, frankly, of the United States in constraining Israel. I mean, so the short answer is, and how I'm advising my investor clients, is to prepare for two long-standing global conflicts. This is already the longest war that Israel has been involved in since 1948.
But I feel, and I was at COP where, the Vice President Kamala Harris came, and it was the first time that she asked, actually, Israel to be more restrained. Is there a shift?
There are efforts going on behind the scenes that I think are very well understood. The remarks from U.S. Defense Secretary Lloyd Austin were quite a change in trend in terms of the advice. And I think President Biden's comments, earlier on in the crisis, don't make the mistake that the U.S. made in Afghanistan. This advice is not heeded, and I think we need to see this as part of the wider trend of the end of the Pax Americana and U.S. influence.
Is there anyone that Israel would listen to?
Well, I think that Israel, the Netanyahu government has a wider goal in mind, which is to eradicate Hamas. But I think that any conflicts involving terrorist movements and kind of revolutionary movements like Hamas are unlikely to be concluded at the negotiating table. And you can see the Secretary General of the United Nations invoking Article 99. Yeah. This could get worse before it gets better.
The Prime Minister of Israel was also warning Lebanon to not get involved. There are concerns that Iran could be more involved than we initially thought, although that's not verified. Do you see this widening?
Well, the U.S. has moved 2 carriers to the Med. There were Iran-backed Houthi rebel attacks on some U.S. positions. And so, below radar or below threshold kinds of military attacks seem likely. Iran has made clear it doesn't want to enter the war, but Iran is playing a spoiler kind of role in both the Middle East conflict and with Russia and Ukraine, and we heard this in Putin's remarks.
I mean, how much more complicated has it become for Ukraine, given the lack of funding or the hesitance of the U.S. to put more money in Ukraine?
I think that the Ukrainian authorities understand that that they're in a very difficult position, and I also think that kind of Putin's newfound global role as he's been traveling to the UAE and meeting in the Middle East reflects the fact that he thinks the momentum is on his side. It'll be up to the U.S. Congress to put an end to that. I'm not sure.
Yeah. So when you look at your research, it's easy to read, it's smart, it's sharp. So we made a wall looking at some of the global insights and some of the hot spots that you see going forward. So we'll put that up, and at the same time, I'm going to ask you what everything changes if President Trump becomes President Trump again. So
yes.
how do you? I imagine you get a lot of questions from your clientele about that. Like, what's your answer?
Well, you can see in the sell-side investment research outlooks that are coming out that they're really sticking to inflation forecasts and interest rates. For this, we have data sets, and almost all of them refer kind of obliquely to geopolitical risk. So we try to pick up where they leave off, but there have never been so many potentially systemic factors in the mix, as well as the kind of reverberations with domestic political considerations like immigration and green policies, right? So U.S. anti-immigration sentiment in Congress and indeed within the public, now interfering with continuing U.S. support for Ukraine. This is a very acute set of geopolitical considerations. Market's still pretty sanguine.
So again, I mean, this is all about divisions, right? Within countries that could get worse and spill over. We have the Taiwanese elections. When you look at your list of worries, where does that show up?
At the moment, it's about in the middle because we're trying to
There's so much else.
Yes, we've still put the Middle East escalation risk and Ukraine escalation risk at the top. Taiwan elections mid-January could be a thorn in the side to China. I was in Asia at the time of the APEC summit talking to investors there who kind of swiftly moved with enthusiasm toward risk on, and better relations. I think the improved mood music between the U.S. and China is a shift in tactics, not strategy.
But, I do find it amazing. Like, if you look at global GDP, I think 60% of people, or 60% of countries that make up global GDP will vote next year. I mean, 2024 is a big year.
It's really astonishing. I mean, 4 billion people will vote in the most populous democracies. So India, South Africa, Mexico, which had huge protests. Of course, the United States. The reason why I call the outlook inflection point is because just how much about, let's say, the second half of this decade depends on these choices. These aren't incremental moves. They're going to be quite significant. I think investors have got their heads around the idea that there could be a Trump 2.0. U.S. investors have good memories of Trump presidency. In Europe and Asia and in the Middle East, it's a very different sense.
Thank you, Tina. Tina Fordham, their founder and geopolitical strategist at Fordham Global Foresight. Now, coming up, German Finance Minister Christian Lindner returns to Berlin after those EU fiscal talks, but it's not much easier on home soil as the German budget negotiations continue. We discuss that next, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
All eyes are on the U.S. job market.
We're moving in the way the Fed wants to see it.
Will the labour market hold up? Look to Friday.
Each one of these economic prints are going to have that much more heft and importance in markets.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The narrative is changing, and the facts are driving that.
How many people are off sides and need to get in and play now?
The November Jobs Report, today on Bloomberg Television and Radio.
The conversations that matter, the insights you need. This is A Pulse. I'm Francine Lacqua here in London. Now, German Finance Minister Christian Lindner says he expects agreement on the government's revised 2024 budget in a couple of days, but it's unlikely to pass through Parliament before the end of the year. Well, for more, let's get straight to Oliver Crook, Bloomberg's Germany correspondent in Berlin. Ollie, so good to have you on the program. So what exactly is the latest on this German budget drama?
Yeah, so the ambition was to get this done and dusted in 2023 and really leave it behind it, but now that plan seems to be dead in the water, and what basically needs to happen is it still needs to be reviewed by the Parliament and has to go through the Parliament. That basically is not going to happen according to Lindner, according to the SPD. And the issue that you've got now is that this is going to drag into 2024, which is a problem politically for this coalition, right? They may be able to agree on their own level, but they really wanted to put this behind them, and that is just not going to happen right now. And so they're still trying to plug that 17 billion euro hole within the budget. And there are really only two ways of doing that, right? You have to cut spending and cut subsidies, or you need to raise revenue from the government. That is higher taxes. That's a red line for the FDP. There is a sort of way you can cheat that, which is the third option, which is what has happened in the prior few years here. Every time there's been a crisis, which is suspending the debt brake. That obviously is at the center of the issues that this government has had. However, could they possibly suspend the debt brake partially for certain initiatives like the subsidies and the money that they're going to give to Ukraine? That's 8 billion euros. That could go a long way. But again, politically, this is a massive issue. The government is not doing well in the polls. And really, the task for them will be coming out and saying that none of these coalition partners are the biggest losers for what is undoubtedly a big losing battle for this government.
Later this morning, the Chancellor, Olaf Scholz's own party's conference also begins in Berlin. So what are we expecting from the SPD?
Yeah, and Francine, this has been completely hijacked, obviously, by this budget situation. And really what they're going to do is they do this every 2 years. So this is actually the last one that they're going to have before the 2025 election, the national election here in Germany. So really they need to set out their agenda and say what their priorities are going to be. For the SPD, those priorities are going to be spending more money on the sort of social initiatives that the SPD cares about, but also greening the economy and also modernizing the economy. How do they intend to pay for that is the question. One of the ways they intend to pay for it is to tax the sort of mega wealthy. That is probably going to be part of it. But part of it, again, comes back to the central issue, the debt brake. They want to suspend the debt brake to the SPD and to the Greens as well. There is one thing that is standing between Germany and a modern green economy of the future, and that is the debt brake.
Oliver, thanks so much. Oliver Crook there in Berlin. Coming up, from the house of Hermes to Gulf royals, we'll bring you Bloomberg's annual global ranking of family fortunes next. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Move over, Waltons. Another family has emerged as the richest dynasty in the world. Now, for the first time, the House of Nayyan has joined Bloomberg's annual ranking of family fortunes and done so at the very top. With the $305 billion fortune, the Al Nayyans of Abu Dhabi topped the Waltons of Walmart by a cool $45 billion. Now, another new entrant, the Al Thanis, the royal family of Qatar, at number 5. So let's get into number 3 on the list, and that's Hermès. Bloomberg's Angelina Rasquet joins us from Paris with the latest. Angelina, first of all, good morning. Can you tell us what's behind the Hermès success, especially since 2010 when LVMH attempted to buy the company?
Indeed, in 2010, LVMH tried to build a stake, and that really shocked the family. It was already a family-controlled business, but following this stealth, stake purchase, they boosted their control over the company even more. And nowadays, Hermès is one of the few luxury companies that's still independent. And since that moment, the stock price of Hermès has risen by more than 1,000%, surpassing the performance of LVMH. And currently, it's led by the 6th generation of heirs. So really, it's been a phenomenal success.
Yeah, and it's amazing. Like, every time you speak to a luxury CEO, they say, Hermès is really the gold standard. So how are they so different to peers? Is it that they sell more or they sell more expensive? Were they able to increase prices?
Yes, indeed. Basically, it's the crown jewel of the market, and it's largely derived due to their supply-constrained model based on artisanship. Basically, demand for its leather goods in particular, think about a Birkin or Calibat, constantly surpasses its output capacity. So Hermès is constantly having to update the markets about leather good openings in France. It has a goal to increase output by about 7%. But still it doesn't manage to keep up with demand. So basically, there's also a juicy resale market. So it's got a lot of pricing power, which is very important in the luxury space. But also, it does things differently because, for instance, all the luxury brands out there, they rely on brand ambassadors, on celebrities, on influencers. You think about Gucci, they recently had a campaign with Kendall Jenner. You think about Chanel, they have Timothée Chalamet or Kristen Stewart. At Hermès, you don't see any famous face promoting their fragrances, their silk scarves, or their bags. So that's really peculiar. And when it comes to the artisanship, I mean, going back to that model, they also want one artisan to do one bag by himself. So for instance, for a Cali bag, it'll take about 20 hours, and they really insist that only one artisan will do it. So really, all in all, a very peculiar way of doing luxury.
Yeah, peculiar way, but that really works. I'm looking at, the luxury sector. It's by far the best performer, 35% gain for its shares. For example, LVMH is only 5% higher, and Gucci or, LVMH is up 5%, and then Kering, which owns Gucci, is actually down. So what's the outlook for 2024?
Exactly. I mean, we've already seen a slowdown this year, and so far what we've seen is that Hermès has been the most resilient. For 2024, Bain put out a report last month, and they expect, in their base case scenario, they expect the market to grow between 1% and 4%. So that's a slowdown from the 8% that we saw this year. Obviously, not all brands are equal, and some will fare better than others. And it's possible, if you're looking at the track record of Hermès, that they'll probably be more resilient, thanks to, again, this image of exclusivity and scarcity. But some analysts already consider that it's too expensive. For instance, Morningstar has a sell rating because it considered that it's too expensive, considered to future earnings, relative to future earnings.
Angelina, thank you so much. Angelina Rusquet there with the very latest, of course, on Hermès. So we put together a list of some of the most fortunate, or the family, of course, dynasties with the most fortunes out there. Now, moments ago, we found out that Nadia Calvino has been picked by EU finance ministers for the top EIB jobs. We'll have plenty more on that throughout the day. We, of course, have U.S. jobs, so a full roundup of what we can expect. That's coming up next. We also look into next week. The big one there will be BOJ. Stocks steady but nervy as they await U.S. jobs data. This is Bloomberg. Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person, I have to worry about my family, I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of a family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Good morning from our world headquarters in New York. I'm Manus Crenny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Jobs Day in the USA. Markets await the latest payrolls data to get a hint on whether the Fed is closer to cutting rates. China vows to strengthen fiscal policy to boost domestic demand as President Xi gathers his top officials in the latest Politburo meeting. The Palestinian Authority is working with U.S. officials on a post-war plan for Gaza. The top leader arguing that Israel's aim is to fully defeat Hamas is unrealistic.
I think if they are ready to come to ground, to an agreement, and really accept the political platform of the BLO, accept the tools of struggle, because this is an important point of difference between us and them. And then there will be a room for talk.
More from our exclusive interview with the Palestinian Prime Minister coming up this hour. Are you nervous? Have you checked your Whisper number on your Bloomberg terminal? The jobs report will be 170,000. There's a lot riding on this number, to the extent that we've had such a rally, a crazed rally, an AI-crazed rally. The NASDAQ 100 was up 1.5% yesterday. You give a little bit back this morning, but rates have gone from 5% to 4%. With very little validation. So today's jobs numbers are what you're going to need to validate both the rally in bonds and in equities. The Whisper number is 170,000, but it was Alphabet. Keep an eye on Alphabet, that's ticking higher this morning. This exploded yesterday. Do you want Gemini? That is the question. Which part of the product suite from Gemini do you want? The largest and most capable AI model. It added $87 billion to the value of Alphabet yesterday in trade. Keep an eye on the mood. Those job numbers will come through. Kalanovic has a big note out. You want to hold cash. Stocks are going to face a moment of truth, a catch-up in 2022. We've got Europe up 0.5%. Luxury is the big take narrative this morning. What do you want to be long of? Keep an eye on Michael Hartnett's note from Bank of America. You're going to face a real moment. Rising bond yields will drag stocks lower. So we have this lower yields, higher stocks at the moment. It's going to flip. Lower yields equals lower stocks. Danny, good morning. Happy Friday. Jobs Day.
Happy Friday, Manus. And you've given me the Friday gift of basically saying everything you can say on bonds. I don't have to do too much work here. But look, it is kind of crazy that we were at 5% in October. We're below 4.2% today. We do move higher, but again, it needs that reassurance from a jobs number that shows us that the economic momentum is one towards a slowdown. That needs to come through, or else Bloomberg Intelligence says that this bond market could turn on a dime. We saw also not just a ferocious rally in bonds, that took a break yesterday, but there was a ferocious rally in the yen. At one point in New York, the Japanese yen was up more than 4% versus the dollar. A lot of that had to do with both the poor bond auction in Japan, which we walked you through yesterday morning, and comments from Ueda. That takes a breather today, but usually this pair is more dependent on the dollar. So be wary of the jobs data today. That could be the next leg of volatility in the yen. Finally, Brent crude, despite the fact it's up 2%, it's rallying after a really bad week. This would put it on track for another weekly loss, and it would be the longest weekly losses since 2018. Manus, you put together a market that is selling off oil, again, not today, but for the large part has been selling off oil. You put those inflation expectations for rate cuts together, and here's what you get. I want to show you what break-evens are doing, because this is how high the bar is for the jobs data to show slowing down. It needs to do that in order for this bond market not to get a reality check. I've got 10s and 5s break-evens on the chart, but look at the 5s here. It's the blue I have. Manus, break-evens are the lowest since 2021. We're just anchored around 2%. Are the jobs numbers going to keep us there?
Yeah, and, you know, has the bond market already priced that collapse in the break-evens to that extent? Well, let's take that very thought to Alex Brazier, Managing Director and Deputy Head of BlackRock Investment Institute. Alex, good to have you with us. I mean, I talked to a couple of different people yesterday. Danny and I have been looking at these break-evens really every morning when we come in. So today's a perfect day to look at it on the jobs data, because it could be fill or kill in terms of the collapse of the break-evens. The people I'm speaking to are saying this indicates a perfect landing, immaculate disinflation, and a soft landing. If you look at the 5s and the 10s, you take the other side of that trade. You say 2024 will be far from the perfect soft landing, immaculate disinflation. So who's wrong? Are the break-evens wrong, or is consensus wrong?
Well, I think the consensus is wrong, and the break-evens are wrong a bit as well. But let me elaborate a bit more on that. So payroll growth has to slow from current rates in order to stop a resurgence of inflation down the road. When you step back and look at what's happened since the pandemic, you know, we've had this big pandemic hole. Payrolls have been slowly climbing out of it to re-establish a sort of pre-pandemic level of employment. But overall, payroll growth has been pretty weak, and it's had to be given the slowdown in the growth rate of the workforce. So the US economy faces this big production constraint. It needs slower payroll growth to avoid a really tight labor market and resurgent inflation. So the Fed needs payroll growth to slow. It needs to see evidence of that over coming months and quarters in order to be sure that we're in a situation where inflation isn't going to come down only to go back up again.
Can I just say, it feels like it's kind of crazy that we're ending the year where we are, that we're ending the year so strong when we've had Credit Suisse collapse, we've had SVB collapse, there were supposed to be rising bankruptcies. There was also supposed to be the property maelstrom in China that ruined everything. But we're not. I mean, we're up 19% on the S&P 500. Bonds continue to rally. Are those risks truly dead and gone?
No, I don't think so. Particularly when you take a step back, look at the broader context. This is the theme of our outlook this week. The context really is everything, because the market swung between hopes for a soft landing and fears of a hard landing, when actually what's been going on underneath is actually that the US economy is on a muted growth track, and it has to be, given these production constraints it faces, and it's going to take higher interest rates than we were used to in the past in order to keep it there. So we're in a kind of structurally weaker growth, structurally higher interest rate environment, but the market's just been swinging around focusing on, is inflation coming down or not? And inflation is coming down a fair degree, but it's not vanquished, and we're in a structurally lower growth and structurally higher rate environment.
But that, I mean, that is the polemic of what everybody comes on this show and talks about. So prepare me for a world. I mean, everybody is banking on this 130, 140 basis points of cuts next year, the ECB to go first. But in America, it is very firmly predicated on rate cuts. That's in part the euphoria. How do you set up a more defensive play for 2024, given that backdrop of higher for a lot longer, is what I'm assuming from you? You say we want to be dynamic indexing and alpha-seeking strategies. I mean, broad terms, but what's my alpha? Where is alpha? Go find alpha.
Well, I think, take US equities, for example. Managing that macro risk of rates coming down, but staying a lot higher than we've been used to in the past, I think makes us cautious about many broad static asset class exposures, including US equities. We don't see those reflecting a structurally higher interest rate environment yet at the aggregate level. But, and I think this is the key thing, we've been through 20 years now where central banks were constantly really reducing rates in order to fight disinflationary pressures. And that's generated a sustained bull market in stocks and bonds. So broad static asset class exposures did about as well as anything else. Now we're in an environment where there's a lot more volatility, a lot more dispersion of returns. You've got to manage that macro risk, but that extra dispersion means there's reward for insight, reward for managing the macro risk, and reward for picking the right selection within each asset class. So, for example, within US equities, we like stocks that are related to the AI theme, in particular its implementation to reduce costs and boost revenues, so beyond chip manufacturers. And I think that's an example of how, even though we see the need to manage macro risk at the broad asset class level, there are more opportunities now for careful selection within broad asset classes.
But one could argue, and many people do argue, we've had Rob Arnott on this program who said it's a big market delusion what's happening with AI right now. How do you look at where valuations have gone and say there's more room to go here?
I think this is a distinction between the chip manufacturers, which have been the first beneficiaries of the repricing of the AI theme. Yeah. But beyond that, the issue now goes to further along the chain, if you like, around, well, who else is an enabler of the implementation of AI? Who's got the data? Who's able to clean the data? And then beyond that to who, completely outside of the tech industry, has got the ability to grasp this, implement it for efficiency gain and maybe revenue gain as well, whether that's in healthcare or other areas.
Interesting. Do you think breadth opens up next year? I mean, part of the paranoia of a lot of fund managers, asset managers, has been exposure to Mag 7. Yes, they've had an exponential year and delivered great growth. The question is, can they deliver that into next year, or do you look for a broader church? And it sounds like you want to look into the supply chains and a broader church rather than just exclusively in the big Delta 7.
Yeah, absolutely, a much broader church. Our need for selectivity, particularly within equities, goes a lot further than, say, within this tech theme. It's into things like healthcare as well, where we see opportunities. But the broader issue here is a big change in the regime from 20 years when a broad static exposure to the whole asset class did about as well as anything else, to a regime of much more macro risk, notwithstanding the fact that inflation's come down and rates have probably peaked, and the need to be much more selective and get much more reward for that now in this new regime, which I think is the central theme of us for next year.
What do you do with high-yield bonds right now? Spreads in this most recent rally are now the tightest in some 19 months. It's kind of the strange non-event that didn't happen, this wave of corporate defaults that were supposed to happen. Does that pick up next year? Do you expect spreads to widen, or can you continue to buy into some of these junk bonds?
Well, we do see some widening of spreads at the aggregate level over the next year. I think looking back on this year, the corporate sector proved much more resilient because it had done a lot of refinancing at very low rates in the earlier period. But you now have a wall of refinancing coming up around about 2025. Companies will be looking to refinance through 2024. Rates are not coming down as quickly as the market is pricing, in our view, and that means we are going to see some corporate distress. Not like a normal distress cycle, though. This is not a cycle. Right. This is a structural shift to a higher rate regime. That makes us cautious about the broad asset class, but a bit like US equities, it means we still see selective opportunities within that asset class where some of these companies are priced for some of the risks.
Being vigilant. Alex, thank you so much for joining us this morning. Really appreciate it. That's Alex Brazier of BlackRock Investment Institute. Manus, some quick breaking lines to bring you. Microsoft probably unhappy with what the CMA has been probing into them for the past year. Before it was Activision, now UK CMA is going to seek views on Microsoft's partnership with OpenAI. They're going to probe that pact to see whether it will impact competition. So again, that's a Microsoft OpenAI partnership together. Previously, of course, the UK CMA took issue with their Activision acquisition that was eventually seen in a better light by them. All right, Manus, let's get to some other top stories that are trending on the terminal this morning. It's a season for bonuses and promotions, at least over at Citi. They've promoted 304 employees to managing director, with executives expanding the firm's roll call tradition to the entire firm. While Barclays promoted 81 employees in its corporate and investment bank to its managing director ranks.
TSMC sales slid back into contraction last month following October's gains, showing there's still a way to go before the global chip market stages a full recovery from a prolonged slump, Danny.
And the presidents of Harvard and Penn were forced to issue statements clarifying their responses to congressional hearing on anti-Semitism after a barrage of criticism from business leaders and politicians. Penn donor Ross Stevens withdrew a $100 million donation over the backlash.
Coming up, we hear exclusively from the Palestinian Prime Minister as the country works with the US on a plan after the war. That's next.
You need a serious paradigm shift. And that serious paradigm shift is not about, don't leave it to the Palestinians and Israelis to end the conflict.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears. Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Israeli occupation to Gaza should not be allowed, one. Second, Gaza should not shrink in terms of territory, and Israel should not be allowed to annex certain areas that they might call buffer zones and so on. Third, there should not be any forced transfer of Palestinians out of Gaza. Egypt has been cooperating very well, and also this is something that we did not want to see in the same way that American administration did not want to see.
Mohammed Shtayyeh, the Palestinian Prime Minister, speaking exclusively to Bloomberg's Ethan Broner. Now, meanwhile, Prime Minister Benjamin Netanyahu has threatened devastation in Beirut in southern Lebanon if Hezbollah opens up a second front in Israel's war with Hamas, saying if Hezbollah decides to open an all-out war, then with its own hands, it will turn Beirut and southern Lebanon, which are not far from here, into Gaza and Khan Yunis. Joining us now is Bloomberg Managing Editor for Economy and Government, Russia, Africa, and Middle East, Sylvia Westphal. Sylvia, when we look at what the Palestinian Prime Minister is hoping to achieve in these talks with U.S. officials, because we've heard from the Israeli side, some of the reporting was being in Gaza for as long as a year after they were able to defeat Hamas. What is the negotiation right now between the U.S. and the Palestinians?
That's right. So the Palestinian leadership says that there have been talks going on with the US about what a post-war Gaza will look like, and that the Palestinian Authority will be part of that. And they've talked about this idea that the Palestinian Prime Minister said that his preferred outcome of the conflict would be for Hamas to actually become a junior partner under the broader Palestine Liberation Organization, and help to begin a new independent state that includes the West Bank, Gaza, and East Jerusalem. Now, of course, this sounds, interesting idea, but this is completely the opposite of what Israel wants to do. Israel says that Hamas has no future in Gaza. It wants to eradicate the group. So it's, where things stand. I think the big question of what will happen in a post-war Gaza is still very much open, and who will run and administer it in the future.
It's going to be a great story and a great sit down by the whole team. The question that goes through my mind is, to what extent can this Prime Minister speak for or have the authority to do a deal? I mean, they were, they were moved from the West Bank. They were both in the West Bank and in Gaza, but that's been limited to the West Bank since 2007. Does he have the authority? Does he have the power? Does he have the mandate?
Not really. I mean, he has an authority in the West Bank, but Gaza is a completely different matter. And, in the past, there have been, rivalries in Gaza. And the last time that the Palestinian Authority was involved in Gaza, it didn't go down very well. So it's a really, really difficult thing. It seems like a very simple solution to say, okay, we need to think about a post-war Gaza. Let's look to the Palestinian Authority to help fix that. But the reality on the ground is very, very different. And there are very divergent ideas on what should happen afterwards in Gaza. And given that the Israeli military has had a ground invasion there, and that it has has this role now there in terms of what's happened in the war. It really doesn't seem like any kind of plan can happen without the Israelis being on board for what happens in Gaza. So, the guess of most commentators is that it's somewhere in between the two extremes, that there'll be some kind of solution, but there is no easy answer for Gaza.
Okay. Sylvia, thank you so much. That's Sylvia Westall there. And of course, Netanyahu responding really quite aggressively in terms of the language there, threatens to devastate, as we said in the introduction, to devastate Beirut if Hezbollah enters the war. And if Hezbollah, an ally of Hamas, has fired on Israel from Lebanon. So again, if they think that there's no boundaries to this war, it's very, very much a mistake. Danny, to what extent is there a war premium in oil? You look at the oil market and you just say to yourself, absolutely none. I mean, okay, this is Netanyahu's response. It's a natural response to the context. But we have an oil market, Danny, which is trying desperately to get off its knees this morning. But you are looking at a bounce back in New York crude of up 1.5%. And that is after 7 weeks. We're still in for a 7-week of a drop here, the longest losing streak since 2018. And I think there's a number of things spooking it. People just seem to lack a belief in the cuts that were announced by OPEC Plus last week, don't they?
Yeah, it's the lack of cuts. It's more supply, especially in the American energy markets. And at the same time, it's silly season across these markets. Volumes are low, and there's more chances for us to be bullied around in this market by, you know what I'm going to say, the algos.
I know.
Knew it was coming.
As a week that was. Okay, those oil markets trying to claw their way back. Today is all about jobs. They need a validation. The bond market needs validation. Equity markets need validation. And I need some validation. We'll leave you with that thought. We'll talk about football and baseball next. I get all the validation I need there on Bloomberg. Good morning. Oh.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. Manus, another day, another potential sports deal, this time from Carlyle's David Rubenstein. According to people familiar, he is interested in buying the Baltimore Orioles. Previously, he had been looking at the Washington Nationals, but Rubenstein, of course, a native of Baltimore. Manus, can you say Baltimore? That's how you say it with a Baltimore accent. So, you know, we're going to get
Baltimore.
you. Baltimore.
Oh. So why have you got an interest?
Yeah.
I mean, I thought it was cookies we were going to talk about this morning. That just shows you where I am on the whole journey with American sport. But why is he interested in the Orioles?
Well, okay, so he was born there for one, and he did give an interview with CNBC where he said, "I'm like the only billionaire who hasn't bought a sports team." But I do want to go back. I do want to go back to the cookies because I just want everyone to know when I called up Manus and I was like, I want to talk about the Orioles. They were my first team that I ever saw play baseball. He goes, "Aren't those like a type of black and white cookies? Oreos? That's not baseball." And then he's like, "Oh, the football team, Manus. They are baseball, and their mascot is a bird, not a cookie." Just want to set the record straight.
I just need you to arrive in the U.S. so that you take me to some of these games or at the Yankee Stadium or whatever else. I mean, you talk about billionaires. Of course, Ken Griffin getting his hands on the Miami Dolphins, or he's in talks on the Miami Dolphins, and then you've got Sportsology and Aries in talks to buy the Texas Rangers. So you're right. I mean, he doesn't want to be left out of what's big for the in crowd, which is if you don't own a sports team, well, you're not in the game. But then, of course, that whole Manchester United story just sort of came and went, and he missed his opportunity there.
Yeah, that's true. We're still waiting to see what sort of the end game of that ends up being. But this doesn't seem like... So the Orioles are the 18th largest team out of 30. I don't think it's going to beat the Mets price tag. Steve Cohen... Go Orioles, I love it. Steve Cohen bought the Mets in 2020 for $2.4 billion. That was the highest price ever paid. But my heart still belongs to the Orioles.
Capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley. Welcome back to your Friday edition of Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Jobs Day in America. Markets await the latest payrolls data to get a hint on whether the Fed is closer to cutting rates. The Palestinian Authority is working with U.S. officials on a post-war plan for Gaza, with the top leader arguing that Israel's aim to fully defeat Hamas is unrealistic. And China vows to strengthen fiscal policy to boost domestic demand as President Xi gathers his top officials in the latest Politburo meeting. So we await the jobs data, and at the moment it is a sell-off in the bond market, but still it's not nearly enough to do this ferocious rally we've seen over the past few months. 10 years, we're 5% in October. We're now below 4.2%, but again, a move higher of 2 basis points. Will we get the validation of slowing economic momentum in today's jobs figure? Also, a wild move over the past 24 hours. The yen strengthened versus the dollar at 1.4% in the New York session yesterday. It was about Ueda making live the possibility of changes come the next meeting this month for the BOJ. We give some of that back today, but it is a volatile market that also has thin liquidity, which means today's job number could also see more ruptures for this currency pair. Finally, Manus, we were just talking about this moments ago. Brent crude, sure, it's up 1.5%, but taking the totality of the week, it is down on track for its longest weekly losing streak since 2018.
Yeah, and that's only going to unseat some of the nerves at the OPEC Plus table. Danny, you're right. I mean, the whisper number, will catch up with Mike McKee very, very shortly. I think last night when he went home, he just shouted from the other side of the screen, it was 163. It's now pipping higher. Since we came in, it's gone up by another 5,000, 175,000. And you're going to need something down in the 130s really to deliver some kind of a validation to the monumental move that you've seen in equities from rates from 5% to 4%. And in part, that has driven the equity market. We've just caught up with BlackRock Institute. They expect go broad and have more dispersion in your portfolio for next year. It's going to be higher rates for a longer period of time. And this market is not assuming that, and it is not basing its trajectory on that. The NASDAQ was up. It absolutely ramped higher yesterday by 1.5%. It was Alphabet, of course, that delivered. Gemini erupting by 5.5% yesterday. We're up 0.25% this morning. There was over $80 billion in equity value added yesterday alone. So this is putting Google, Alphabet head-to-head with Microsoft, OpenAI. Futures this morning just a little bit lighter there. You have Stock 600 up 0.5%. We've got a great big take. We're going to spend some time on the luxury market this morning, but there are a couple of notes out there. Kalanovic, as always, Friday morning, here's what you want to do. You want to hold more cash as stocks are going to face a catch 2022. That's similar to BlackRock, actually. And money market funds have 5.9 trillion, Danny. Another new record in terms of the momentum for those money markets. The other main headline is just to keep in the back of your mind is China. They, as we said in the headlines, they're going to step up their fiscal support, Danny, for the recovery. They're holding on to that 5% level, aren't they? And they're vowing, this is what they're vowing, that they're going to target monetary policy, and they drop the word forceful from their guidance. So it's an interesting nuance in terms of the language. Danny?
It is, and on that language nuance, the Politburo meeting also didn't give any wording specifically on property or local debt. They did talk about this idea that they want to have a better quality of economic growth and to really hone in on some of the areas of risk. Maybe that was kind of hinting at property, but again, Manus, no specific language at a time when we're still wondering what's going to happen with Evergrande, for example. That liquidity hearing had been delayed, so there's still some questions, but no specific wording.
Yeah, I mean, they have gone to the extent of issuing new debt and loosening some of the frameworks around that to give succor to the economy. So, you know, let's just keep an eye on that. It's certainly there. The Politburo meeting gives no wording on property and local debt. I think that's probably very telling, Danny.
Yeah, no, it certainly is. Also hoping to strengthen foreign investment in China. This comes off the back of Xi also in San Francisco meeting with business leaders. Now, speaking of American business, let's turn to tech because we have a new headline breaking out of the UK. Only moments ago, the CMA is seeking views on Microsoft's partnership with OpenAI. In other words, investigating whether this poses competition risks. For more on this, let's bring in Mandeep Singh of Bloomberg Intelligence. Mandeep, the CMA knows how to kill a party. We're just off the back of this ferocious rally in AI yesterday. Now we have the CMA questioning this relationship between Microsoft and OpenAI. What sort of argument do you think the CMA might be looking for in terms of there being a competition issue between the two?
I mean, even before this whole thing happened with OpenAI, I feel, the fact that Microsoft had a 49% stake and, such a big influence on OpenAI in terms of how they train their models, the consumption of Microsoft Cloud credits, you could argue, it pretty much owns the company or at least has a majority stake. And that's where, the fact that Microsoft is so deeply involved, it has a board seat now. It does put into question the whole relationship. And if you compare it to Anthropic Google or Anthropic Amazon, those are still minority investments, not to the scale of 49% that Microsoft has in OpenAI.
Good to see you, Mandeep. Well, just timing is everything. We booked you, they broke the news, and there's the first reaction. Now, you mentioned Alphabet there. Of course, they launched Gemini in the dog days of December. Is it the big, broad church? Is it the blockbuster product? Will it, from what you've seen or from what you've heard, really go head-to-head with OpenAI?
I mean, right now, the immediate task for Alphabet was to prove that they're not behind OpenAI. And a lot of people were questioning their ability to ship a large language model product. What they have shown is not only have they caught up with OpenAI in terms of the benchmarks that they showed in the paper, but also they shipped it in 3 different versions, one for the device, one for cloud inferencing, and one for cloud training. And that's how the market will evolve. So they are sort of setting the standard in terms of how people should think about this space altogether, and clearly ties in very closely with their search business, YouTube business. So they have the distribution. The question was, can they ship products? And they have shown that they can.
I wonder what you make of Bloomberg Opinion's Parmi Olson writing, the days between Thanksgiving and Christmas are normally a dead zone for launching new technology, but these are desperate times for Google. Does the timing smell of desperation to you, Mandeep?
Not really. I think, again, everyone was keen to have Google ship more products, given the Bard chatbot launch didn't go very well earlier in the year. So people were questioning what the real underlying technology was. And I think the timing seems to be perfect because everyone is moving very fast in this space. I mean, you can see there is a real sense of urgency around generative AI strategy, having a large language model or a partnership. So the fact that Alphabet is out there will help them build their ecosystem. I mean, they are a formidable enterprise cloud player now in conjunction with Amazon, AWS, and Microsoft Azure. So this helps their cloud strategy as well.
Okay, well, a lot can happen in the dog days before Christmas. Mandeep, thank you very much. Mandeep Singh, the Bloomberg Intelligence. First take on the breaking news on the CMA investigating Microsoft OpenAI. Now, it's a tech fuel stock rally. We've told you that every day. You've got that message. Pre-market investors, they're waiting for the latest U.S. jobs report. The former New York Fed President, Bill Dudley, spoke exclusively to Bloomberg on what to expect. Let's listen in.
People are really focused on a couple of things in this report. Number one, how sturdy is payroll employment growth? You're going to get some benefit of the fact that the UAW auto worker strike in the U.S. is over and people are going back to work. And so that's going to tend to boost the payroll gain. Average hourly earnings is also going to get a lot of scrutiny because wage gains are running north of 4% on a year-over-year basis. That's too high to be consistent with 2% inflation.
Well, let's bring in the man that will break the numbers. It is our Bloomberg economic and policy correspondent, Michael McKee. Mike, we got you up early. We got you in here. You're tracking the Whisper number. Here's the thing for markets. The bond markets have moved a phenomenal 5% to 4% in a very short space of time. But a number in the 170s isn't going to validate that. What is it that the market's going to be more focused on?
Well, it might, in this sense. And Bill Dudley made a very good point, along with having a great view behind him. I'm not sure where he was, but you have to add in, well, subtract out the UAW effect this time. There were 33,000 people off the payrolls, off manufacturing payrolls last month, according to the government. And if you add those back into that 175, and then if you take them out, you're going to see a number much closer to 150 where we were last month. So there is still a likelihood that we're going to see a relatively soft number. The anticipation is not that we're going to see the 130 that you were talking about that people might like to see as evidence.
But I think it was greater minds than I that we're talking about 130 now. Come on.
But we do have to. They told us there'd be no math. They lied. We are going to have to do some mental math when this number comes out.
Well, thank goodness you are breaking it, Mike, and not me. My mental math is very bad. But look, everyone expects, somewhat resilient figures to come out. I mean, that's what we've seen this whole time. So when it comes to what the Fed is looking for, what's more important for them to dissect?
Well, I think the two things they're going to look at are the unemployment rate, as long as we get a headline number that's within a reasonable range. The unemployment rate, because they forecast by the end of the year we'd be at 4.1%, and we're at 3.9 now. How close do they come to their number? Do we come in under it? That would be good news for them and feed that immaculate disinflation soft landing narrative. And they'll also, as Bill Dudley was saying, be looking at the wage number. Now, it's still running at 4.1% above what the Fed thinks is sustainable, which is generally 3 to 3.5%, but it's been moving in the right direction. And if we get another step down in the year-over-year average, then they'll see that as good news as well.
I mean, the number they're going for there is, plus 0.2% on the month of November. So that's consistent with the 2% target from the Fed. But do you think that the heat has come out of this wage negotiation market? We've closed off those sort of very, very public wage negotiations with the auto workers. Is there a sense that we've passed over the top of the hill on this wage power by the workers in the economy? That's probably the bigger issue, isn't it?
Well, there seems to be a general agreement that we've done that. We've gotten past the major union negotiations that bring in a lot of people at a particular contract level, but also measures that suggest what people are making from switching jobs. ADP has a figure on that. Also, the ECI that the Fed watches closely. It looks like we're past the peak, that people are not getting huge raises anymore from switching jobs, and companies are not having to pay up to get workers as much anymore.
Less than a week to go, Mike, until the Fed decision for December. Does this change anything for them, the figure that comes out?
Barring some big surprise, it doesn't. They've pretty much told us they're going to hold steady. What it might have an effect on, depending on which numbers go which direction, is what they do in 2024. I think on Wednesday of next week, when we get the Fed meeting decision, what's going to be important is not so much the decision, since, as they've said, they've not going to do anything, but what they forecast in their summary of economic projections and the dot plot. Does the dot plot come anywhere close to pricing in the kind of cuts that the market is pricing in at this time? And where do they see unemployment and inflation going? That'll be the first thing everybody turns to on Wednesday. So we'll try to plug in some numbers from today and see if that has any influence.
Send me your Excel spreadsheet, Mike. Manis and I have a thing where he makes fun of mine, but I know you've got one, so I want to see it. I'm expecting it when the report's over. Mike, thank you so much. Bloomberg's Michael McKee. And, of course, stay tuned for that jobs report. Bloomberg will walk you through. Manis, though, this market awaits the figures, perhaps on a sleepy December Friday ahead of a jobs report. You don't want to take any big risks. S&P 500 futures slightly higher after that big old rally thanks to AI. We're just talking to Mandeep about this. The Google Gemini taking us there. Dollar a little change, yields move higher. But, Manis, again, it is this crazy madness. We're at 4.17%, 17%. We were at 5% just in October.
Indeed, validation of a vicious rally. That's what we need, a valedictory move. Okay, we're going to take you to the House of Hermes, and Gulf Royals will bring you Bloomberg's annual global ranking of family fortunes. That's up next.
names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
The reception, the acceptance of Puro Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's Bloomberg Brief. I'm Manus Cranny in New York, Danny Berger in London. Move over, Waltons. Another family has emerged as the richest dynasty in the world. For the first time, the House of Nahyan has joined the Bloomberg annual ranking of family fortunes and done so at the very top. With $305 billion fortune, the Abu Dhabi-based family topped the Waltons of Walmart by $45 billion. Coming in at number 3 on the list, Hermès, the family. And behind the story of today, the big take, and Hermès, is Angeline Rascouet. She joins us now from Paris. Angeline, good to see you. I mean, this Hermès story is the thing. It's the thing of movies. The bags are in the movies. Danny's waiting for one for Christmas. She could be waiting a long time. But talk us through the success of Hermès, because they battered away Louis Vuitton, didn't they? And it just went on to deliver splendid returns.
Indeed, in 2010, LVMH and Bernard Arnault unveiled a stake in Hermès, and that really shocked the Hermès family at the time. They were already in control of Hermès, but they managed to build a structure that gave them even more control for the future years. And nowadays, Hermès is one of the few independent luxury companies, and it's led right now by the 6th generation of heirs. And since 2010, basically, the stock price has risen by more than 1,000%, surpassing the performance of LVMH, and it has created basically the wealthiest family in Europe. So that's a phenomenal success there.
It's so fascinating because with the most recent luxury earnings, a lot of them had difficulties, whether it be sort of the aspirational luxury client or the upper end starting to pull back. But Hermès occupies this rarefied space that it seems so immune. What's made Hermès so special that they were able to get to this place that gives them such resiliency?
Exactly. Basically, their model is based on, it's a supply constrained model based on artisanship. Basically, demand for their leather goods, their bags, basically, the demand constantly surpasses their output capacity. So Hermès is constantly having to update investors about its goal to raise, their output. They have a goal to raise about their output by about 7% on an annual basis. But also, they haven't industrialized. They want their leather goods to be made by artisans in France. So one artisan will spend about 20 hours on a Kelly bag, for instance. And they want that because they feel like the artisan will be proud to see his or her finished product. And when it comes to marketing, Hermes does things differently as well from the rest of the industry. You think about Gucci, you know, they use celebrities to promote their goods. Gucci recently had a campaign with Kendall Jenner. Chanel, it's often associated with Kristen Stewart or Timothée Chalamet. At Hermes, you will not have a celebrity ambassador. Basically, the ambassador is the product itself. And you know, and you probably know, the company is also not big on logos plastered all over its products. It's the epitome of quiet luxury.
Oh, Angeline, you're going to get a call from Louis Vuitton after the end of this discussion. You don't want your LV. They've rebranded, haven't they? You don't want those monikers everywhere. Look, what is the risk with Hermes? Because if you think about it, Hermes, Louis Vuitton, etc., a lot of it is built on heritage and artisan craft work. Is the supply chain, I mean, that's where the Birkin bags went ballistic in some ways, because during the pandemic, A, it was an investment, B, you couldn't get the artisans to make the product. Is there a supply chain risk with Hermes, a real supply chain cliff risk?
I mean, for instance, all of their handbags are made in France, and they're very clear that they want to boost capacity, but it's just that, you know, there's only so much they can boost. But when it comes to demand, I mean, this year we've seen that there's been a luxury slowdown for luxury goods, but Hermes has been more resilient. And I mean, when it comes to 2024, Bain put out a report last month, and they see that growth overall for the industry is going to grow between 1% and 4% in their base case scenario, compared to an 8% growth in 2023. But historically, Hermes has been more resilient. So we'll have to see if they're still growing, but by double-digit growth rates.
You know, Manus, I feel like because they do this supply thing, when anyone gets it, they treat it so pristinely. It's always so perfect in all the pictures of celebrities. Can I tell you what I'm going to do when I get a Birkin bag?
Go on.
I'm going to throw that thing around. I'm going to overstuff it. It's going to look awful, and I think that's the coolest thing you can do with a Birkin bag. That's what mine's going to look like.
That is the cool kids' response, you know, rather than
yeah.
In Dubai, they used to bring you your bag. You used to bring you your little stool for your handbag itself for the ladies. There you go, and for gentlemen as well, because we're out there in old Dubai Mall of the Emirates, and literally you went to a restaurant and your Birkin bag had its very own little stool. Angeline, there you go, a whole business for Hermes to pick up themselves, their own monikered stool for the Hermes Birkin bag.
That's how we got to live. A seat for me and a seat for my Birkin. Angelina, thanks so much. That's Angelina Roscoe in Paris. All right, coming up, we're going to have a look at some of the market-moving events to watch throughout the day. It's not just Jobs Day, but it's mostly Jobs Day. That's coming up next.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Let's get you set up for your Friday. Here's what's ahead in the trading day today. The main event is going to be the latest U.S. jobs report. That hits at 8:30 a.m. Eastern. The estimate is for 183,000. Whisper number currently stands at 175,000. Then we're going to get another data point that the Fed will be closely watching. That's the UMich consumer sentiment. That hits at 10 a.m. We're also going to get earnings from Manchester United. Owner Ineos's founder, Jim Ratcliffe, is said to be working on a minority takeover as soon as next week. So that might be interesting. But Manus, what risk are you really going to put on the table in this very moment until 8:30 a.m. when we get that jobs report?
Yeah, and as you said, the whisper number is now up at 170, 175. That was at 170 when we walked in. It was at 164 yesterday, so they're squeezing it higher. It's going to be about the wages component, and if you strip out the jobs that have rolled back in as a result of the auto workers' strikes, as Mike said, you could be looking in the 150s, but it's not going to be the 130s that the market and the bond market probably needs to validate the swoon in rates. I like the word swoon.
Yeah, it's a little bit of a weird number because of that UAW figures in there, which, Manus, Mike McKee, I think he basically admitted to me he has an Excel spreadsheet for there. So there you go, Manus. I'm not the only one. I'm not the only nerd here.
It's not nerd. It's where you add value and bring shine every day to Bloomberg Brief. Look at that. We didn't break anything, thank goodness. We'll see you on Monday. And we'll know what the jobs numbers in then. Wait.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
In order to really ensure that inflation's back to target, I think you do need to see some more labor market loosening.
We still have more and more evidence pointing in the direction of the labor market softening.
I think there is still some underlying strength in the labor market.
The jobs market now is coming into question in terms of how resilient it really is.
The employment rate will move up, and as you know, I've mentioned before, I think we'll probably have a hard-ish landing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Let's get you to the weekend. It is Payrolls Friday, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Your equity market just about positive on the S&P 500. TK, your number, the estimate in our survey this morning, 183.
Yeah, folded right into claims from yesterday. Double barrel them, and the answers claims came out. It was a yawn. It was a snooze fest. Do we get a snooze fest today? Or either way, do we get some form of major market response? It's been interesting to see how markets have locked down since, say, 6 p.m. yesterday.
It's the first chapter of a three-part act, TK. We've got CPI, Bramo, next week, and then, Lisa, it's on to the Federal Reserve.
Yeah, and how are they going to interpret this, given the fact that they really haven't pushed back before the quiet period, as much as some people thought that they might, to the easing financial conditions? Just to give you a sense of how much financial conditions have eased, spreads, the extra yield on high-yield bonds is now the lowest going back to 2021. We are talking about a massive retracement of some of the risk-on kinds of feels, which raises this question, okay, have we eased too much, given the fact that we still have a robust labor market?
Do you want the pushback this morning? It comes from Marko Kolanovic over at JP Morgan. Here it is. Here's the quote, Tom. The risk-reward in equities and other risk assets is worse than in cash or bonds. He calls it a catch-22 situation. We would need to first see some market declines in volatility during 2024, Tom, before easing of monetary conditions and a more sustainable rally.
It's a class note. He leads it with a single sentence of 2023. He thought it would be slow. It wasn't. He was wrong, period. So he readjusts, he recalibrates like everybody else, and the bet here is for a more subdued market.
What did Bramo say? We got the grow before we got the slow.
I think Steve Whiting said that.
Okay, hold on a second. There is this sort of question where people are betting on a slow and then grow. So can you bet on the growing before the slowing? And this is a real question, because can you expect some sort of rebound in growth if we haven't even seen the downturn that's necessary to get there?
Thank you so much for clarifying that.
You're welcome.
Here are the scores this morning.
Please, give us some math.
We look a little something like this on the S&P. Futures just about positive by 0.05%. 3 days without gains on the S&P. And then we bounced, and we bounced hard, led by big tech. In the bond market, yields a little bit higher by 3 basis points. On a 10-year, Bramo, 417.97.
There is only one event today. It is the 8:30 a.m. non-farm payrolls report for the month of November. I'm watching the unemployment rate, because even if you get a good payrolls number, do we see an ongoing tick upward in the unemployment rate? The expectation is for it to stay at 3.9%. If we get to 4%, even if it's a good number, does that change the conversation just a little bit about the nature of who's getting hired and who's not staying in the labor market? Today, we get reaction from the report from Jeffrey Rosenberg of BlackRock in the 8:30 half hour. And then in the 9 a.m. hour, Bloomberg opinion columnist Mohamed El-Arian and acting Labor Secretary Julie Su will be joining Jonathan Farrow. At 10 a.m., University of Michigan Sentiment Survey. I am really excited for this one, because this gives you a sense. No, this actually is important this time. No, it actually is.
I'm agreeing with you.
Okay, so the 5 to 10 year inflation expectations ticked up in the last survey to the highest levels going back more than a decade. Do we see that continue, or do we see that come back down? The expectation over the next 5 to 10 years of 3.2%, which went up even as gasoline prices went down.
I don't. How can we look out 5 to 10 years? That would be my arch question. I mean, who's making that guess?
You may ask that question every month, Tom. It's a beautiful thing.
I know they ask it, but I don't know what the value is because I really don't know. Like, where am I going to be in 1 year?
Once put a lot of weight on it, and then all of a sudden did not put a lot of weight on it. Tom, and kind of turned his back on all of that. Steve Whiting's with us, Chief Investment Strategist, Chief Economist at Citi Global Wealth. Good morning, Steve.
Good morning.
Before we get into the big outlook for 2024, let's talk about 8:30 a.m. this morning. What are you looking for?
Well, look, I think that the forecasts for 180,000, are unbiased. This is not the seasonal extreme of the year. We're still in a seasonal upswing in hiring in the month, but not as extreme as the month of October. I mean, the big picture on this is this year, employment gains, 239,000, a little more than half of last year's gains. And you know what's coming? The coming year, it's going to be slower still. And that's going to matter for the Fed. It's going to be in a different situation for other parts of the economy where, we've had this very large rebound in labor-intensive services hiring for a couple of years now. And it's given us this period of monetary tightening deep into a period when a lot of industries have adjusted, but labor markets have been strong. It's going to be an interesting story when that reverses in the coming year.
Do you agree with Bank of America's Michael Hartnett that essentially, he has a fancier way of saying this, but bad news is now bad news, and that essentially if you get a rally in treasuries, that's going to be negative for risk assets?
Bad news for whom? For what? I don't really believe this. I think that productivity growth is rebounding. Again, it may have gotten exaggerated in the third quarter. The labor market has been strong. Measured inflation is going to come down. Right. The Federal Reserve is going to swerve to trying to protect the expansion that we have. And that's going to be good for financial markets.
Yeah, I think well, first of all, bad news is defined this morning as Juan Soto going to the New York Yankees. That is bad news for Red Sox.
That's bad news for the Red Sox.
That's bad news. It's like the way the Tots lost yesterday to West Ham.
On that.
Which is bad
Unbelievable.
news.
You are the single best I know at folding profits into our economics. And the key thing here, and Lisa's wonderful observation of grow and slow, is can we get both? Can we get a slowing economy, and yet corporations will adjust to a lower nominal GDP, and they're still going to grow profits?
So if we take a look at this year, for the most part, it hasn't been a great year for profits. Through mid-year, EPS were down 6%. The majority of industries had a decline in profits. This is why the S&P equal weight index is up 6% and the headline's up 19, for market cap. This is the reason why most stocks are not doing well. Right? Now, this is not a collapse. This is not a depressed period where you can have a V-shaped recovery from it. But profitability, I think, is going to be coming back. Manufacturing across the world has contracted for a year. Trade has fallen as much as 9% across the world. It's really quite coincident with what's going on with profits. We've had this pre-recession in industry, except for employment.
I like that phrase.
Well, the employment side, again, has been held up by this rebound in services. Everything's been out of sync since the pandemic, and everyone just focuses in on that, but that's the piece that I think slows going forward.
We just put up a non-farm payroll survey, your middle tendency here in the parlor game. Give us the SPX parlor game. Fold your economics into where you think, and I don't mean what David Balin says or Citigroup, just your basic idea that if corporations grow, can we have a more optimistic
Yes, I think we'll have a new record high in U.S. corporate profits by early 2025. It won't be quite as good as the consensus estimates, but those are known to be biased upwards. I think we're going to beat estimates for the next couple of quarters quite handily, while rates are coming down, employment is slowing, and the Fed is swerving.
So you're whispering in Jane Frazier's ear 6,000 on SPX?
Well, someday, but that's that one's pretty far.
Someday, there's the answer.
Is there a home bias to this call on stocks?
Well, I think, we, for the last 3-4 months, been focused more in on U.S. performers, small and mid-cap growth stocks that are under-levered, have strong EPS growth and trading at 15 times earnings. Why were they all left behind? Last year's Magnificent Seven had EPS declines. Now they've had very, very big gains. And if you take a look at that reversal, I think we're going to get other pieces of the U.S. market to rebound. And then I think we could broaden out to the world later on in late 24 into 25.
The banks are part of that story.
Well, it's very interesting. I mean, they're trading at 45-year relative lows in terms of performance. They could bounce back, and yet, this is not really about long-term growth. We see a lot of areas of very interesting long-term growth that I think would be sustained for a longer period of recovery than a bounce back.
So I've been looking right now at credit pretty intensively because it's been moving along with equities and then some. I misstated earlier, high-yield bond spreads are the lowest going back more than a year, April 2022.
Outperform those small caps.
Outperformed the small caps, outperformed a lot of aspects of the equity market. People talking about a golden era for credit of all sorts. Is that fading now?
Well, look, I'm not sure that the rate environment really, should be discounted here entirely and should look only at spreads. If you take a look at private credit yields, 12%. Companies that are not part of the bond market paying 15%, that are money good. So yield levels, borrowing costs across the economy are up a lot.
Yeah, but just riddle me this. How we can have companies that grew up with paying 4% or 5% for their debt suddenly having to pay 15%, and that doesn't somehow diminish their creditworthiness in a material way. How have we gotten to this space where suddenly they can manage payments that 5 years ago people said was an impossibility?
Well, zero was, we never really got to the point of embedding zero forever. I think in some valuations. And I think that the forthcoming maturity wall is pretty empty for 2024 for both high yield and high grade. Then you look further out, it starts to become an issue. But I think we overshot a little bit on rates. Now, again, these are more normal yields than 2020, but we're not going to 1980 either.
I'll be criticized for this, but I'm going to go there. 2023 has been one big value trap. Everybody said, I got to go to value. And as a general statement, it hasn't worked out. What are the signals where all of a sudden value's not a value trap, where it has value?
2022 was the period where defensive value performed really well. Large cap pharma. Now you have some interesting stories. Talk about a narrow market of, GLP drugs and two companies. I think
Let's
again.
talk about that. Is the sector more than just that?
Well, again, through tech, through healthcare, it's an incredibly narrow tape. And so the value trap is partly a consequence of things are just not that great for most companies. And, where are they headed? So they should hire everybody. They should have 239,000 jobs per month. No, they won't. And so that's the piece that will slow. But a lot of the cyclicals, which some of them fit into value, I think will recover in the coming year.
Energy too?
Look, I think we're at an oil price. Let's just remember that the last 4 recessions, Brent reached lows averaging $24 a barrel after the last 4 downturns. We think that OPEC is, at least our take on this, is managing, to decline in terms of their output, in terms of their influence, but boost the oil price in the process. So they're giving a gift to oil producers in the rest of the world.
You guys had the call of the year with a guy named Edward Morse. He's pretty good at hydrocarbons. What are you going to do when Morse walks out the door? He's of an August age. He's announced his retirement. What do you do on hydrocarbons if a guy like Morse exits stage right?
He's been a great partner and will continue to use a really, really strong commodities team.
Does he know you're calling $24 a barrel for oil?
You misheard me.
I misheard you. That's part of the X, Steve.
No. Okay. Yeah, 75, not 24.
So the average is 24 over the last 4 downturns.
Yeah, at the bottoms.
Big skew
for the last 4
from
downturns.
the pandemic, though.
Yeah,
Big
and so look, I think that we're going to have, there's a lot of risky oil around the world. Russia and Iran are 20% of global output. Now, they have all the incentives in the world to keep producing, but the oil price on average, we think with OPEC cuts, is going to be higher. And that is going to benefit all sorts of conventional and alts, at least compared to where they would be at a collapsed oil price.
I think we can suggest that maybe that number is distorted by those negative prices we had 3 years ago. Maybe just a little bit.
Yeah.
Just a little bit.
I'm not counting futures, I'm counting spots.
Okay, interesting. Thanks for that, Steve.
All right.
Appreciate that clarification. Steve Whiting there of Citi Global Wealth. Let's go to the broader price section. Going into payrolls, the scores look like this in the equity market. Futures just about positive by 0.05% on the S&P. Yields north of 4.1%, getting closer to 420, Lisa. Up 3 basis points to 418.16.
But really, this is the stability people were looking for. I mean, the sense that we're not necessarily cratering and we're not exactly skyrocketing, the fact that even on the heels of a potential shift in Bank of Japan policy, we're getting such minor moves really highlights how much the landscape landscape has shifted and how people are sort of stable in this landscape.
There was nothing stable about dollar yen yesterday afternoon. Do you see those moves? TK, dollar yen at one point, negative 3.8%. That currency pair just cratered yesterday afternoon.
This is strong. It's strong yen, and you know some of the movement there persists this morning as well. And I'm sorry, it sets us up for Sunday evening our time. You know, when are they going to do this? They're going to do this over the weekend. They're not going to do this.
Oh, you think they're going to hike
time.
rates over the weekend?
No, but I got my radar up. I mean, I've canceled. I've blown out my entire weekend calendar to wait for what the BOJ is going to do.
Right, okay.
I was going to decorate the tree, but we'll wait.
From New York City this morning. Good morning.
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. All eyes are on the U.S. job market.
We're moving in the way the Fed wants to see it.
Will the labor market hold up? Look to Friday.
Each one of these economic prints are going to have that much more heft and importance in markets.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The narrative is changing, and the facts are driving that.
How many people are off sides and need to get in and play now?
The November Jobs Report, today on Bloomberg Television and Radio.
For Israel to say that they are going to eradicate or eliminate Hamas, I don't think that's a possible goal to achieve, simply because Hamas is not in Gaza only. Hamas is in Lebanon, Hamas in leadership, everybody knows, in Qatar, and they are here in the West Bank, and so on and so forth. So what is needed really is a situation in which that Palestinian unity should be allowed to function on very clear bonds and agenda.
Fascinating conversation. That was the Palestinian Prime Minister in a conversation with Bloomberg in the West Bank on the challenges Israel faces in its goal of destroying Hamas. More on that in just a moment. From New York City this morning, good morning. Payroll's just around the corner, 2 hours and about 13 minutes away. Your estimate this morning, TK, very, very close to 180K. 183 is the median estimate in our survey, and equity futures are going absolutely nowhere.
Yeah, I'm going to go to where Lisa was earlier on something as boring and staid as the unemployment rate. And John, you're going to have a conversation with the Department of Labor here in the 9 o'clock hour. And I'm sorry, there's a huge difference off 3.9 of 4.0 or 3.8. And just that little tick may do more than any other data point. 4.1 would be, wow.
The lower the cycle, Lisa, 3.4% on unemployment. It matters.
Yeah, 0.5% increase, and that actually is sort of a key metric as we head into whatever happens next.
And Claudia Sahm has said the same thing. She said, you know, there's over-analysis of her Sahm rule, except today it may matter.
Yeah, I think everyone's going to be talking about that Sahm rule.
Yeah.
Maybe butchering it. I know she gets frustrated about it. We'll catch up with Claudia, hopefully, in the next few weeks, Tom, to clarify what she thinks it all means.
It's going to be interesting to see, to say the least. What we know is into the weekend, we will see more news and mystery out of a war in the Eastern Mediterranean. We've had the huge advantage of the services of Norman Rule, former senior U.S. intelligence official, non-resident senior advisor at CSIS, the Transnational Threats Project. Norman, thank you so much for a Friday visit this morning. I see Secretary Blinken essentially lecturing the Israelis. Is the Israeli military, and I believe it's Khan Yunis, 4 miles from the Egyptian border. There seems to be 2 conversations going on, a military prosecution of war, whatever, conflict, and as Lisa's beautifully said, the after the matter, the after the debate matter. Which is more important?
Well, good morning. Both are not only important, but they must take place in parallel. And actually, there are several conversations that are happening in the region. You first have the issue that Israel remains committed to the eradication of Hamas as a military threat. And the United States, for whatever the Secretary's comments might be, is committed to providing them with the material support to do so and the political space to get this done and recover hostages. You then have a very real humanitarian crisis, which is getting worse daily, that must be addressed. And this is going to put limits on the Israeli operations. And last, to your point of the day after, you have a series of growing diplomatic efforts involving multiple international partners to put together a structure that doesn't have very strong scaffolding within it. The Palestinian Authority, the Israelis, even the international community is not very well structured to support a day after architecture at present.
You were saying that Israel's goal hasn't changed, and we were just hearing there from the Prime Minister of the Palestinian Authority saying it's not possible to achieve that goal, to get rid of Hamas. What's your sense on that?
It's certainly possible for Israel to destroy, to kill Hamas's senior-most military leadership, and they're doing a pretty good job at this within Gaza right now, having taken out several dozen Hamas leaders. They'll also be able to destroy much of Hamas's military and technical capability. But I don't think Israel believes it's going to be able to kill 33,000 fighters. And there are Hamas operatives in West Bank, in Lebanon, and in Qatar. The question is, if you go into the Palestinian Prime Minister's comments, if he wants to make Hamas a junior member of a Palestinian coalition, will Hamas agree to accept the state of Israel? Or will you have a coalition in Palestine that includes a prominent partner, likely the one that would win an election if an election took place in the Palestinian territories, and that partner is dedicated to the eradication of the state of Israel?
I have to wonder, though, what Israel is losing in the process as this drags on, because there are thousands of people who are dying. You mentioned the humanitarian crisis that is mounting, a lack of access to clean water, a lack of access to health care, crowded conditions. This is all creating and breeding disease and hunger that could potentially kill more people than the conflict. At what point do you kind of get on board with what Lloyd Austin is talking about of the U.S. when he says that Israel risks a strategic defeat even if they win in their objective?
Israel probably has a matter of weeks left to conduct these operations, perhaps through mid or late January. But it's also important to understand that Hamas knows this, and Hamas is using these humanitarian losses to build world opinion against Israel. And Hamas's survival rests within the concept of, if there is enough pressure on Israel to stop operations, Hamas survives, the resistance has proven it's successful, and that itself could doom a two-state solution, if only because Hamas, which has survived, is committed to the eradication of Israel.
How do you have a two-state solution with a group like Hamas?
You can't. You need a Palestinian Authority or a Palestinian entity that's willing to accept Israel, just as you need an Israeli government, which doesn't necessarily exist at present, that's willing to make significant political concessions to Palestine.
So in 5 weeks, you're suggesting, based on decades of experience, Israel's done with whatever they're done with. Then what?
There is a significant, robust diplomatic effort behind the scenes right now to build this, and this is not certain, and it's very challenging. Will Prime Minister Netanyahu survive? Can the Palestinian Authority actually run Gaza? Is the international community willing to put skin in the game and the resources for what will be long-term and contentious negotiations? None of this should be taken for granted. But all of it is required if we are to prevent this from happening again. And last, Iran and its proxies won't stand by idly while this is occurring. Just as they put a spoke in the wheel of the Saudi rapprochement with Israel, they'll want to do the same thing as two-state talks go forward.
So, Norman, let's talk about that and let's finish that. What can we do about the Iran issue?
Well, Iran has traditionally constrained its activities when it faces multilateral pressure, economic pressure, diplomatic isolation, and a genuine feeling of military retaliation. Frankly, all three of those are absent at present. Its proxies fire with very little response. The international community is fragmented. I think at present, right now, we just have to have assets in place for a worst case scenario and accept that Iran will keep things bubbling in various locales, much as they're doing at present.
Norman, thank you, sir. As always, Norman Rule there of CSIS. TK, we have to go back only a couple of months. We were on the brink, seemingly, of some kind of diplomatic agreement between Saudi Arabia and Israel, not in Iran's interest at all.
Every time we have Mr. Rule on, I learn something, and all of a sudden I have a 5-week window. I mean, here's somebody who's really experienced, saying this military effort's out 5 weeks, 4 weeks, 6 weeks. Let's give it some wiggle room. But to Lisa's point, the then what is just extraordinary. It's like original.
There has been, there has been a quiet, though, from Saudi Arabia. And I think it's really important to note this, that there's a real question around what the political pressure is to stop this war from Middle East actors, other countries that previously were putting out certain rhetoric that didn't match with their actions. So it raises this question in the path forward. What role will Saudi Arabia play? Will they continue to try to normalize relations with Israel? What about Qatar and some of its negotiations to try to get some more hostages released?
This is important. I did a panel years ago. I'm not going to name a university. I'm at a panel with some fancy people, and they're trying to figure out what the Afghanistan society will look like after the war. And it was, seriously, folks, the most surreal panel I've ever done, and there have been some doozies. And the answer, John, is that's how I feel about this. We're all talking about what's going to be out there, and right now we're prosecuting a massive hand-to-hand combat 4 miles from the Egyptian border.
Yeah. Why can't we name the college?
I don't.
Okay, no. All right.
Afterthoughts applying.
What the Secrecy Act's all about, but all right. We're going to turn our attention to the labour market. That report 2 hours away. Rabida Faruqi of High Frequency Economics joining us in just a moment. Your estimate, 183,000. The previous number, 150K. From New York City, this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
2 hours away from the jobs report, here are the scores for you on the S&P 500. A day of gains yesterday, decent day of gains across the board. The Nasdaq doing nicely as well in yesterday's session. This morning, just a little bit lower by 0.1% on the Nasdaq, just a little bit higher on the S&P 500. Let's call it unchanged, going flat, going absolutely nowhere, Tom. But in the bond market, we've been going somewhere. We have come down a ton from where we were the morning of the last jobs report, close to 5%, now close to 450, 462.25. Yields up by, let's call it 3 basis points.
Yeah, and over since Jobs Day, John, we just looked it up. You can do this on the Bloomberg Professional Service under the HP function. John, 4.99% last Jobs Day, just the day before, to 4.62 on the 2-year. And the 10-year yield was 4 point whatever, and we're already down to 4.18. I mean, we had a real, I think that frames it across a jobs report, the lower yield.
Has that been validated by the data, do you think? Is there a split between the economic data, what we're pricing, and what we're getting in terms of communication from the Federal Reserve?
I think you guys follow this more than I do. There's been a consensus view that the job market will weaken, and we're waiting.
Okay, pause, rewind. I'll ask the question again. Lisa, has this been validated by the data?
There you go.
Okay, not with respect to,
well,
hold on a second, not with respect to economic data. We just heard Steve Whiting there basically say, well, bad news for who? We've seen actually an increase in productivity, an increase in employment, different metrics. The disinflation, though, has been notable. And that, I think, is the data that has shifted and that has really spurred people to have a bid into bonds, even with a constructive backdrop in the labor market. This idea that we could get immaculate disinflation, that it was just transitory. It's basically the return of a narrative with nobody saying that this is the narrative they're all following.
I keep going back to what I've said over the last couple of weeks. The data's still pretty decent. I know it's disappointed relative to expectations, but output's still pretty strong, and we haven't seen a re-acceleration in inflation off the back of that. These disinflationary trends, Tom, have continued. Best way to capture that this week, the ISM. Headline number was decent, prices paid was lower. To Lisa's point on productivity, better, unit labor costs down. These are all things that the Fed was shooting for 12 months ago.
Is a generalization, disinflation benefits the haves within the financialization of the American economic experiment. Those in finance, those doing finance, they win, and the rest of America, there's a lot of pain out there, flat on their back. I saw a bankruptcy chart in the last 48 hours. It was grim.
Well, yeah, and you can see the dollar stores are not doing as well as you would expect during this kind of period of time. Look, there are many different layers, and this is the reason why we keep talking about rolling recessions, rolling economies, rolling market shifts, and I think that that's what makes it so difficult to get our hands around. Nonetheless, the bottom line is, can we have a job-full slowdown without any pain? Can we get some sort of slowing and cooling with it not being bad news, to Steve Whiting's point, to everything being Goldilocks until it's actually just amazing, right? I mean, is this basically the sort of baked-in understanding of what 2024 is going to look like?
I'd ask this, Lisa. How much of the rebalancing have we had so far off the back of the Federal Reserve tightening? How much of this has been about Federal Reserve policy? And if you do believe the cumulative tightening that's in the pipeline is still yet to come through, then the downturn's coming to an economy near you, isn't it?
That is an incredibly good point, and one that we have to really keep in our minds. And that's why I was asking about credit, because at a certain point, you got to think companies that got used to paying 5% are going to blink again if they're going to have to pay 15%. A lot of people would say that the tightening and the disinflation we've seen so far is the immaculate disinflation, is the transitory, and just has to do with year-over-year comps on the heels of the pandemic.
She's mentioned transitory 3 times.
Because that's what people are saying
Lisa
with that
loves
thing.
the T word.
It's
big on the T word, this one, for a long time. Let's get to foreign exchange. Not encouraging that. Let's get to the euro. The euro against the dollar shaping up as follows. Just a final quote for you. 107.83, just about unchanged on the day. That currency paired negative by 0.1%. Here are your top stories. Under surveillance this morning, counting down to the jobs report, just under 2 hours away. The median estimate in our survey calling for 183,000 on non-farm payrolls. A wide range of views on the street. Deutsche Bank at the low end, 130k. Goldman looking for a print, Lisa, of 238. Ian Shepardson at Pantheon Macroeconomics. What was he looking for earlier this week? 275. Oof.
But here's a question that I have, and I have this every single labor market report, but even more so this time around. Is the headline figure going to matter, or is it going to be in the payrolls, in the pay raises? Is it going to be in the jobless rate? Is it going to be in some of these other metrics that people are looking at to confirm either Goldilocks, a slowdown, or a reacceleration down the line?
What's the UAW bump in this? 40?
40,000.
40k, something like that. So we've got to subtract that and then focus on unemployment wages. I get it. That's kind of like the guidebook to payrolls a little bit later. Top story coming out of China. The top party leaders pledging to boost the economy as the country strives to reach its goal of 5% growth. President Xi Jinping saying the country will step up fiscal policy and be flexible and targeted with monetary policy, having previously talked of being, quote, forceful. We're reading the tea leaves here, Tom. China looking to fend off woes in the property market and a credit downgrade from Moody's earlier this week. Love this story from the Financial Times, giving you a little bit of colour on that downgrade from Moody's. Lead paragraph. Moody's advised staff in China to work from home ahead of its cut to the outlook for the country's sovereign credit rating, a suggestion staff believed was prompted by concern over Beijing's possible reaction. Some amazing reporting going on.
Friedrich Hayek on Liberty, John Gray with a wonderful one volume on that. And the bottom line is you have to clear markets, John. How do you clear a balance sheet challenge like property markets with the goings on, the income statement like matter of the Chinese people and the Chinese economy given a totalitarian regime? This is an original experiment.
And, you know, they don't really want to increase leverage, so they're going to jawbone it as long as they can, which is how the market's basically taking some of these proclamations of we're going to support things, we're going to have fiscal policy, we're going to support you, and everyone's saying, yeah, you've been saying that for
Where's the avenue to write down balance sheet loss? I don't see it.
Can we trust research on China right now for anyone who has a presence in China?
I don't have
an answer. The fact that Moody's reportedly kept people at home ahead of the downgrade, Lisa, because they're worried about retaliation and what would happen?
Well, this building on the fact that China advised research arms of banks not to publish anything negative. So it raises this question, what do you want to publish? I mean, if you can't be analytical and you call me a bear, but if you can't be skeptical, what are you doing?
What are you doing?
I think that it's a wait-and-see issue. We've seen this cycle many times before on the Chinese balance sheet. Does it unravel the same time with write-downs and, you know, policy prescriptions of thousands of people at a Congress, or is there a new calculus for President Xi? We don't know.
Lisa and I included this story just for you, the last one, this one here. The family behind luxury brand Hermes is now Europe's richest, with wealth of more than $150 billion, according to Bloomberg reporting. The family fortune up about 59% from last year, while shares of Hermes have risen 35% this year, far outpacing rivals, including LVMH and Kering. TK, you know this story, this family inside and out.
I sent this to Tara Patel and Angelina Raskoway. For anybody, this is the first read of the weekend, not because it's some fancy luxury thing, but it's where a family said no. And the bottom line is 15 years ago, they said to the guy that runs LVMH, Louis Vuitton and the rest, said, no, you're not going to take us out. And that's the heart of the story, and it's the way they did that. The one thing I would say, Lisa, that's important here with the Dumas family and Hermes and all that, is they have taken over the craft French labor economy by setting up little outposts all over France, basically to co-opt the politicians. And it works like a charm, particularly Friday on Jobs Day, when with guilt, you have to make an appearance, John, right?
Well, They're very good with select sort of restrictions in terms of scarcity. And they also are really good at saying some choice words to LVMH after rising 1,000% since that 13 years ago.
Can you share those choice words? What are those choice words?
They're fantastic words that I'm not going to share.
Okay.
But it's a great way of spurning, I'll just say that, spurning LVMH.
Lisa.
It's Friday.
That works on radio.
It's been a long week.
No, I get it. That's great.
Saving shopping daily at Hermes.
There's always an extra layer to Bramo. You just have to keep pushing, and then it
really?
comes out. Then you find out what she really means.
Let's move on.
It's like the three of us are married. Rabila Faruqi saves us, Chief U.S. Economist, High Frequency Economics. Rabila, I love your report and that it's very, what I'm going to call centric, predictable about this jobs report. To you, what is the unpredictable item at 8:30 this morning?
Good morning. We're really looking beyond the payrolls, headline payrolls number. We're seeing job growth is strong. It has decelerated a bit if you look at, the 2023 numbers compared to 2022. But it's really that unemployment rate. We saw a decline in the civilian labor force. We saw a decline in employment. And that's the part, I would expect that the civilian labor force part was an anomaly. But, it's that employment portion of it. And is that going to persist? So I think the unemployment rate is going to be important. That's also something that the Fed is going to be watching, because as inflation continues to decelerate, the effect of the full force of what they have done so far, we think that is still in the pipeline, and that's going to affect the growth trajectory, the labor market, and the growth trajectory.
Rabila, one thing that we haven't talked about ahead of this labor market report today is just the hours worked every week. And this is something that I see increasingly in a